an abundance of different markets. There's going to be an abundance of use cases. And look, you're just not being practical if you don't think centralized, high performance exchanges are going to play a major role in that future.
There are huge merits to centralization for certain functions. Different structures serve different functions. So maybe it'd be kind of fun if you could share with us kind of the story behind the Wyoming Bank Charter. I hear there's a story behind that.
Yeah, there is. It is a long and tortured one, but the most interesting part about the Wyoming story is that it didn't begin in Wyoming. It began in Delaware, of all places, with the Delaware Blockchain Initiative. Back in 2016, Andrea Tignano and another client and I got together, and we worked together with the state of Delaware. She was working with the state of Delaware, and they were looking to get involved in blockchain technology somehow. They saw it as the future. They saw it as transformative. And they brought us in to achieve some very specific and clear goals. And we actually achieved some of them, but we didn't achieve all of them. So one of the things we did is we amended the Delaware General Corporation Law, which sounds boring, but the amendment was actually amazing. It said companies can rely on the contents of a blockchain for their books and records, for their legally operative books and records. A company can just point to the Ethereum blockchain and say that those are my books and records, which means the Ethereum blockchain and a smart contract can hold your entire stock ledger if you wanted it to. Companies need this in order to enter, the blockchain revolution. But there are a lot of things that we didn't do, and one of them was to create a brand new financial services license, or a brand new financial services charter. One of the people involved in the initiative that really pushed it forward was Caitlin Long, who is not a Delaware native, but a Wyoming native, Wyoming's native daughter. And she brought this idea back to Wyoming, who already had an outsized presence in corporate formation and that sort of thing. She was the instigator. She was patient zero in Wyoming that continued the vision of the Delaware Blockchain Initiative that we couldn't get done in Delaware, and formed the Wyoming Blockchain Task Force. And from there, this whole concept of amendments to the Uniform Commercial Code in Wyoming and a new bank charter and a bunch of other things started to blossom. It really is thanks to her, but it all started in 2016 in Wyoming, and it continued when we failed at doing some things, and now we're succeeding in Wyoming. But I don't think this is like the story of any particular state. This is an idea whose time has come. There is just no reason there shouldn't be a charter like this. The supervisory regime is incredibly robust, and clearly the companies want it, and the people like it.
Do you see a sort of community growing or popping up in Wyoming, kind of in this sort of license as an anchor for that, or how do you look at? I know you said it's maybe not a necessarily state-by-state story, but I'm just curious if you've seen inflows of interest in Wyoming or just heard gossip.
Yeah, absolutely. I mean, I have other lawyers that I've known forever, or lawyers that I've never met, who will tug on my sleeve and say, how do we get involved in Wyoming? What is there opportunity there? What's your experience been like? And I tell them it's been terrific. They're not like some backwater regulator. Like, people think people from the coasts in particular look at Wyoming. They're like, what the heck? Why Wyoming? It's the middle of the country. It's literally shaped like a square. What is why would you go to Wyoming for this? And the answer isn't because of like the geography. It's because of the people who have educated themselves way past the understanding of any other state regulator, including here in New York, on how to regulate crypto companies. I mean, they are using crypto to regulate crypto. By that I mean, I'll give you an example. Your typical bank, when it's audited by its regulator, has a human being gets a call from another human being, And maybe the human being misses the call and they got to call back tomorrow and the next day. And then, oh, they pick up the phone, they're able to connect. They set a time for the audit and a date for the audit. They block off a conference room. Some human beings walk into the building and they sit there in the conference room and they look at documents. And all the documents are just representations and promises and some signatures and by golly, trust me's of the fact that the money is there. Wyoming doesn't do that. At least they don't do it with crypto. For the crypto that a Wyoming SPDI holds, Wyoming verifies the existence of that crypto and the control of the bank over that crypto on chain. They do that all directly on chain. They don't have to hire a bunch of people out of school to put on their regulator hat and come on and check boxes. Like that is ancient stuff. And it's a danger to consumers because all that is happening days and days and days after what's really happening on chain. And Wyoming can view all that in real time because they have a robust regulatory system, a robust oversight and surveillance system, because they really understand how to use the technology to regulate the technology. Other regulators are in the Stone Ages on this stuff.
Is there a specific individual that spearheaded the Wyoming effort? Because that took a lot of, I think, foresight, especially amongst like a group of regulators. It's unusual.
Yeah, absolutely. The Wyoming Division of Banking has had incredible foresight, and there is not a crypto person in this, certainly not in this chat. I would say not in this industry that could walk into their office and teach them a few things about how blockchains work. Not happening. They are so far. They're ahead of me on a lot of things. Like a lot of things, and that was really important to us. Like, why would you sit down and explain to a regulator how basic, fundamental things work in the technology that is your livelihood when you can go to a regulator that already gets it and sees the risks for what they really are?
So there's a good Pineapple World has a good. I think it's a rehypothecation question. I don't think you guys can lend out funds. So his exact question is, does U.S. regulations allow a U.S. bank exchange's treasury to use their customer funds in DeFi liquidity, staking, and farming? How does the FDIC insurance deal with a crypto bank's treasury decisions? I think it's a great question.
Yeah, it's a fantastic question, actually. And it really gets to the heart of what the difference is between an SPDI and, say, a federally chartered bank, an NA, right, as opposed to an SPDI. So the NAs lend, and they lend on fractional reserves. They are permitted to hypothecate and rehypothecate, not to their heart's content. There are Basel regulations that say this is prudent and that is not prudent. And it's not just picking stuff out of the sky. It's based on historical activity and statistical analysis. But when the insolvency event happens, it happens. And if you're caught, what is it, without wearing swim shorts when the tide's out, you're caught, right? That's not something that an SPDI can do. The SPDI cannot rehypothecate assets. It does not engage in fractional reserve lending. Other banks, in fact, are not only permitted to engage in fractional reserve lending, but they are obligated to engage in lending, and that's not something we wanted to do. That's the kind of stuff that requires FDIC oversight. The SPDI doesn't do that stuff, so the regulator that regulates that stuff isn't involved. We don't fall under the FDI Act. We don't have the FDIC to answer to. We do answer to the Fed, and we do answer to the state regulator, which I was just talking about, has a tremendous oversight regime.
Amazing. Thank you. That was a great question. What I would love to just, I know that you have a meeting in a little bit, but quickly, I would love to touch on kind of just what's happening in the centralized exchange space. There's a lot of activity, and if you'd like to just comment on kind of what's going on, that would be amazing.
Just at a high level, I mean, so we're in a bull market now. Although if you ask CNN, if the price drops by 2%, we're in a bear market, right? But no, we're in a bull market now, and there is all the things that come along in a crypto bull market are happening right now. And so one of the things, I've done for a long time is get very deeply involved in corporate development and mergers and acquisitions. And one of the weird things about a crypto bull market, it's a little different than a bull market in traditional finance. In a bull market in traditional finance, all the companies that really think it might make sense to get acquired right about now, they go out there and they find suitors and they get acquired and they do right by their shareholders. But crypto has this weird phenomenon where as soon as there's a bull market, it really looks like acquisition makes sense. And it really looks like you're finally going to get out and do right by your shareholders and get the maximum value, or you're going to be able to join this great platform and work under someone's bigger umbrella. As soon as it starts looking like that's possible, people start thinking, I don't know, maybe I shouldn't sell. Crypto's on the up and our treasury's a little bit bigger, and everybody forgets about the bear markets that come around the corner. Jill Carlson, someone who I respect deeply, used to, back in 2017, like pound her fists and stomp her feet and say, this is bull market thinking to crypto people. And, she was like Cassandra, right? Nobody listened to her at that point because it was 2017. It was free money. It's happening again. And so in the world of centralized finance where M&A oftentimes makes sense, it's a challenging environment.
Awesome. Well, thank you so much for your time, and this has been amazing. And yeah, talk to you soon. Thank you.
Thanks for having me.
Yeah, this is fantastic. Thank you so much for your time. We're going to transition to our next session now. Hey everyone, we're here for our next session, which is on Tether's history, where we are today, and learnings for other asset-backed stablecoins. Would you guys mind introducing yourselves?
Yeah, I'll start. My name's Stephen McClurg. I'll be moderating the panel, but mostly sitting back and listening to Phil and Jake talk. I'm the co-founder and CEO of Basket, which is a stablecoin company focused on building a new kind of stablecoin that generates yield, that's wrapped in a security that has access to several different markets.
I'm Jake Chervinsky. I'm general counsel for Compound Labs. We are an open source software development company working in the crypto space. We originally developed the Compound protocol on the Ethereum blockchain, which is an interest rate market for digital assets. We also just launched a new project that we're working on this week called Gateway, which actually produces a sort of stablecoin-like asset called Cash that tracks the value of the dollar. So working on stablecoins in that sense. I'm really glad to be here to chat with you guys.
I'm Phil Potter. I guess currently I'm the CEO of Potter Ventures, doing a lot of sort of early stage investment in crypto companies, but I'm formerly the Chief Strategy Officer of Bitfinex, as well as the Chief Strategy Officer of Tether. I'm the co-founder of Tether and the co-inventor of the stablecoin, I guess. So one way to describe it.
Great. Well, starting off, first of all, thanks Phil and Jake for joining us today. And I'd like to start off by just asking, Phil to start off by talking about the history of the stablecoin, and then as you go, Jake, please step in and talk about where it's going.
Sure. Thanks, Steve. So, where to start? The idea for a stablecoin kind of emerged back in 2013, really around the idea that it was very unclear how governments were going to regulate crypto exchanges, right? So you had this situation where crypto was exploding in popularity, at least on a relative basis back then, right? I mean, Bitcoin started the year at, I don't know what it was, $25, $50. And then, of course, in the course of that year, went up to $1,000 plus. And certainly there was the Silk Road takedown that summer and or the spring. So a lot of things were happening that were gaining the attention of regulators. And what it became clear is that it was the regulators didn't know what to do, or didn't even understand what Bitcoin was, and then didn't really understand what to do about crypto exchanges. And banks, frankly, didn't want to have anything to do with crypto exchanges. So there was kind of ultimately kind of two problems here. There was a problem of, like, for a crypto exchange was accessing fiat, as well as potential regulation around running an exchange, right? So, whatever protections a government would want to put into place for consumers or what have you. So the idea was, it's like, well, what if we were able to separate the compliance problem into two pieces? And one was, and so to me, it seemed like, it seemed pretty obvious to me at the time, was since it appeared at the time, at least, that Cryptsy and people like Cryptsy or MintPal or others that were only crypto in and out seemed to be getting a free ride at the time. Like, we were like, oh, there's no real regulation there. The government doesn't really recognize this as something it needs to regulate. I'm like, oh, okay, well, and then what if we had, what if dollars were in fact a crypto? What if we had a crypto dollar? I called it a crypto dollar at the time. And then we had a system where we could, tokenize dollars on the blockchain. And my tagline at the time was, well, we can create PayPal on the blockchain. And that was really all it is. It's like, how do I create what looks like PayPal, but instead of using a centralized database, well, why don't I piggyback this on top of a public blockchain? And that was really the beginning of it. And we found other like-minded people in the industry and partnered, and there was the search for the right protocol to use back then, because what were we gonna use? Colored coins. It was Counterparty. It was Mastercoin at the time. Now Omni. Ultimately, we settled on Omni because my co-creator Craig Sellers was running that project, and it seemed like the right way to go. But for the longest time, I mean, created it. It's like you think build it and they will come, but no one came. There was no real interest in Tether for quite a while because Bitfinex was the only network for Tether. I mean, there were a few other really small players that were integrating Tether at the behest of, because other people who were shareholders in this process had investments in other small companies, and they would try to bring them into the fold. But the real moment, I think the real moment for the market to realize that stablecoins were useful, really centered around, I think it was really around the time that the hard fork occurred on Ethereum after the DAO hack. So Ethereum Classic emerged as a thing, kind of quite unexpectedly, and Poloniex, which was basically a nobody exchange at the time, was the first out with supporting ETC. And so all of a sudden, all this liquidity rushed over there, and there was so much trading volume in this. But they were the only other exchange that integrated Tether early on. Why not? They didn't have a bank account. And again, I think that was a relationship that Craig had over there, got them to do the integration to OmniCore. Great. Now all of a sudden there was and then we released, Bitfinex put Ethereum Classic out there for our customers, and now there was this arbitrage channel that existed between Poloniex and Bitfinex that never existed before, that could happen in blockchain times versus bank settlement times, which is orders of magnitude different. And that's where it started. And then we said, well, what other assets does Polo have that we don't have yet? And then we added XRP, and then we added, and then all of a sudden this started happening, and then other exchanges, or it was Kraken or Bittrex or this, exchanges around the world, got on board, and I think the rest is kind of history. That's the point which it came into the sort of the zeitgeist of crypto tools, which in turn enable platforms like Compound to exist and have relative. DeFi doesn't exist without stable coins, really. So that's kind of the early history there.
Yeah, it's super fascinating to hear the history, and also that it took so long sort of for it to catch on, because to me, the value of stablecoins is just obvious, right? I mean, what Bitcoin does for the transfer of value, right? Making it borderless, almost instant, almost free, right? This is such a categorical improvement on the traditional financial system that, everyone who gets involved, I think, in Bitcoin from the start sort of understands what a huge improvement it is. But, I think it's also obvious that a lot of people really just want to transact in US dollars, like it or not, right? Bitcoin is not the global reserve currency. Maybe someday it will be, but we're pretty far from that. But bringing the same benefits of a public blockchain to the transfer and settlement of dollars is just a huge deal. And I think, to me, that's pretty obvious. And the market has shown how much demand there is for that. I think, maybe it was in 2017 that, all of a sudden stablecoins really became, as you said, a huge deal. I guess just to throw in a couple thoughts about Tether and what's happened recently, which I think has been in the news a lot. Tether has become somewhat controversial. And I think some of that stems from valid concerns that were alleged by the New York Attorney General that there was an issue where Tether was described as being one-to-one backed, every US dollar Tether backed by $1 US in a bank account. And there was a period of time where that may not have been true, or so the New York Attorney General alleges, and launched an investigation into. And I'll admit, there was a period of time where I was really skeptical about this, right? Because there's an element of Bitcoin, one of the sort of most amazing and innovative elements of it, which is you do not have to trust a third party for the value of the Bitcoin that you hold in your wallet. Whereas for a stable coin that is issued by a centralized third party like Tether, you are in a sense trusting Tether that your USDT is actually backed by a dollar that you can redeem at some point, right? So there is that element of trust. And I think those allegations that perhaps that trust had been violated were serious and worth looking into. The thing is, this spun out into this wild, crazy conspiracy theory that a bunch of people who I think just hate Bitcoin decided to make up in their own minds. So, what started as sort of a legitimate inquiry became theories that Bitcoin only had value because Tether was printing new USDT without any capital inflows of dollars, or that Tether had no reserves at all. And the whole thing was actually a sham, and there really weren't any bank accounts holding any dollars at all.
Car wash tokens.
There you go. And I mean, I think there was never any evidence to support any of that. And what happened recently, which I think is, first of all, in a way, a strong vindication for Tether itself, but also just a great signal in general for the crypto markets, is the settlement with the New York Attorney General, in which Tether paid, I think it was $18.5 million, and made no admissions of wrongdoing. And, the Tether truthers sort of very quickly moved on to a new argument, right? For starters, it was the Attorney General.
Those goalposts are always moving. Yeah.
Just really quickly, right? It was the Attorney General is going to take down this massive fraud. And then the settlement comes out. And now the story is, no, the Attorney General was never going to take down this massive fraud. Actually, it's some other agency that's going to do that. And I guess what I'll tell you is, and then we can sort of move on to talking about, where we are today and lessons from what's going to happen next. But, my background before getting into crypto was in government enforcement defense. So, once upon a time, I would have been working, for a company like Tether, on this type of investigation and working out that kind of settlement with a government agency like the Attorney General in New York. And I think what folks need to understand about this is when there is a thorough investigation like this was, and let's give credit to the NYAG, right? When they investigate something like this, they don't do it halfway. They do comprehensive investigations. Oh, yeah. And I think millions of pages of documents were turned over, in this investigation over the course of years. If there is a finding, and this is somewhat speculation, but this is just sort of how this stuff works. If there are findings of serious fraud, you don't see a settlement like this, right? Instead, what you see is something more like what was alleged in the case of BitMEX, where on the same day, you see a whole lot of allegations come down in a very serious fashion from all of the agencies that have been involved in the investigation. That's not to cast aspersions on BitMEX, right? They're innocent until proven guilty, just like everyone else. But the settlement speaks volumes, I think, about the lack of evidence of these supposed frauds. And I also think, sort of to move on to what's coming next, one of the great things to come out of the settlement is that Tether will be making more disclosures, right? They will be required to make more disclosures about what the assets are that are backing Tether. And in truth, that's what really matters, right? Is making sure that the market has information about the value of the assets that they're able to purchase and sell. So I guess I'm sort of curious, Phil, from your perspective, this whole issue of disclosures and attestations versus audits and sort of how you address this issue of trusting a third party issuing a stable coin. I mean, what are your thoughts about how we move forward on that?
Right. So I would just preface my comments by saying that, I left Tether in early 2018. So the crux of what NYAG alleged and, all post-dated me by quite some time. But that said, I was just reading yet another article kind of recapitulating this settlement in the FT a couple days ago. And one thing that always hits me, it kills me every time, and I want to be very clear about this, is that in the article they're like, and by the way, Tether still refuses to be audited. And this always seems to be a refrain that we hear constantly from the sort of the truther camp, if you want to call it that, or just people, the doubters, right? The reality is that it's certainly when I was there, and I'm almost certain this continues to this day, Tether would have no problem has no problem with being audited, just no one wants to do it. And if you have been in and around that industry, you would know that, the client acceptance process at an auditing firm is rigorous. For a lot of these firms, reputational risk is everything. I mean, when we saw the Enron, Arthur Andersen thing, go down, like ever since then, which was a long time ago at this point, these auditing firms have been very, very careful about the types of clients they bring on. And for them, to earn a few $100,000 or maybe $1 million in fees was just not worth it, given what they perceived was the incalculable sort of fat tail risk on what if they pull the wool over our eyes or somehow, and we are somehow implicated in some grand fraud. So at the end of the day, Tether didn't fire its auditor Friedman. They fired Tether, and never gave a real reason. Tether tried to find anyone that would be willing to audit them. The best that they could do is go to Fries, Sullivan, and Sporkin. They said, well, let's go talk to Louis Freeh's law firm in Washington. I mean, who's more reputable than a former FBI director? But the market wasn't satisfied with that attestation either. Oh, they're not accountants. Well, come on. I mean, yeah, they're reputable lawyers and ex-federal judges and heads of the of law enforcement agencies. Whatever the case may be, no stablecoin in the world, as far as I know, is subject to any type of like full audit. And that's a misleading term to begin with. What they get is attestations, and an attestation is really nothing more than an accounting firm saying, yeah, we've seen the records. We maybe double check directly with the bank. Yes, monies are there. This appears to be the number of outstanding tokens according to the blockchain. Okay. Now, we don't see any other liabilities on the books as of today, but we can't say for sure. That's all that any stable coin has right now.
I'm just not to cut you off. I'm just curious, what is the difference between that and an audit? Like, what would an audit tell you that the attestation doesn't tell you?
Well, I mean, I think that there would be, at the end of the day, it's really, in order for a accounting firm to say, yes, these are the assets and these are the liabilities, they would have to look at the complete history of all the assets and liabilities. So they would essentially have to go back essentially to, the last time the books were audited, and then go for that but since it's never really been properly audited, you kind of in some ways would have to go back to transaction number one and track everything and make sure that, and it's, that's just complicated. And frankly, the assurance industry is just either not ready to do that type of thing, or they don't really have an interest in doing it. But that's what it would be. You'd have to build up the entire history to make sure there was no hidden liabilities, or like, oh, the assets that are here, this is actually a loan, or this is, so right. That's the essential difference.
Yeah. And I mean, I guess from my perspective, I mean, you're right. No one has an audit who is a stablecoin issuer, right? And I think the stablecoins that, at least in the US, are viewed as being the most reputable, which I would say is probably USDC. They also don't do audits. They do attestations, right? So they'll every month publish an attestation saying, here's how many USDC are in circulation. Here's how many dollars are in this, in this account. And that's more or less what it is. I do think going forward, look, stablecoins have really exploded just in the last year, right? I think volumes of stablecoins are, in the tens of billions of dollars now and growing very rapidly. And we also saw the OCC, Brian Brooks, before he stepped down, his OCC issued an interpretive letter saying, basically, this is valid settlement infrastructure for financial institutions, right? I mean, whether that interpretation will stand up under
survive, right?
I think, yeah, is yet to be seen. But I think the point is, right, stablecoins have a really bright future. I think that what we will have to figure out is, from a regulatory perspective, what assurances are sufficient in order for financial institutions and other people to sort of comfortably and confidently use these assets. I would say in my mind, an attestation shouldn't be sufficient long-term, right? I think it's as good as anyone's been able to do so far. But to me, the benefits of that audit, right, where you say, not only are these dollars in this account, but also the dollars are unencumbered, right? They're not from a loan that are getting sent somewhere else. Or also the dollars are not at a high risk of being involved in money laundering or terrorist financing, and therefore will be seized by some government authority or something like that. I think all of that is really important. And I just wonder how we're going to get there. It's almost a chicken and egg problem, right? You need to convince the Deloitte's, KPMG's, Ernst & Young's, et cetera, of the world to do these types of audits before you could pass some new rulemaking or legislation requiring those audits. Because if you require them right now, well, that's the end of the stablecoin industry. And I think nobody wants that. So I think we're going to have to sort of figure out how to blaze the trail. Maybe these auditors will be more interested to get involved now that stablecoins are blowing up.
Right. So I think that one of the, I think you're 100% right, Jake. I mean, I think that one of the issues is going to be that even if you look at the stablecoins that have been specifically approved by the New York Department of Financial Services, say Paxos and Gemini, for example, these are two products that operate exactly the same way as Tether. There's a lot of KYC and AML compliance happening on the on-ramp and off-ramp. And despite what anyone will say about Tether, I can tell you, at least when I was there, that stuff was always, there was always heavy KYC and AML for any fiat transactions coming in and out. Period. End of story. And it's always been that way at Tether and at Bitfinex, and continues to be to this day, to my knowledge. Now, that said, once they're issued and they're in the wild, even the NYDFS acknowledges that they can pass around without KYC or AML controls on a public blockchain, and that's what's happening today. I think that my guess is that will change in the future. Hopefully, it will change, and that's the reason why I think auditors would have a hard time, being able to count all of those liabilities correctly, because they don't know who's holding those things, and they don't know, for example, if Kim Jong-un is sitting on a bunch of Tether, or USDC or what have you, because he would be a sanctioned person, for example, and that would, those are the types of unknowns that the big four accounting firms are they're gonna just say, we're just not gonna do that right now.
Yeah.
So I think that down the road, I think that it's coming. I mean, I think that we need to be aware of the fact that issued assets, whether it be stable coins, whether it be security tokens or other types of securitized interests, will eventually have to interface with some type of identity solution. Now, whether that's like a blinded solution that just all it's saying that I don't need to know who you are, just that I'm allowed to transact with you. I think it's going to be something that looks like that. But I don't know. I feel like that's the next big thing that I think the industry is going to have to tackle if we're going to look for broader blockchain utility in issued assets.
Yeah, I tend to agree. I guess actually sort of two separate issues here in my mind. One is, in terms of audits, right? If the question is, can we give confidence to the market and to regulators that these digital assets are fully backed by a reserve held in a bank account? I actually wonder if auditors even need to bother looking at who's holding the digital asset. Right? To me, all they should need to do is look at the dollars in the bank account and trace who sent the dollars in and sort of what other encumbrances there might be on those dollars, right? To figure out if they're...
I agree from a technical perspective, you're 100% right. I just think that there's the unknown that goes into the category of reputational risk. That
right.
It's like, we don't need to know who's holding these things, I guess, but sure would suck if there was if we did a full audit of these guys and then there was some huge government case and all these tokens got frozen and there's and there's some kind of child pornography thing going on, and or human trafficking and paid for in USDC or whatever. Like, that would be bad news.
Yeah.
And no auditor would get off, they would end up spending millions, way more than they collected in fees, just dealing with their own, defending their, doing their own, KYA, cover your ass, right?
Right. Yeah.
So,
right. And I can tell you from personal experience, having worked with these folks on anti-corruption and anti-money laundering investigations, I don't think you can find a more risk-averse group of folks than the auditors at these, especially at the 100%. Big Four firms.
100%.
I guess let me throw in just on the other side here the thoughts from the DeFi perspective, because I think DeFi addresses sort of both of these points in different directions. I think on the audit side, in terms of can we be sure that these digital assets representing the value of $1 are fully backed, on that question, DeFi sort of natively solves that issue, right? The beauty of DeFi is that the collateral isn't in a bank account where you're not really sure what's in the account. There's no real-time auditing. You don't really know what other legal agreements might be around those assets, right? The collateral is locked in a smart contract on the blockchain that can be audited at any time and is visible to anyone, right? There is no question about something like DAI being fully backed by a basket of assets in the MCD smart contract. Yeah. On the other side, though, right, I think there's more concerns about the second point that you've raised about who holds these assets. And I think one benefit that the centralized issuers like Tether have is, if there are law enforcement concerns, right? Kim Jong-un is holding US dollar Tether. Well, guess what? Tether can freeze those assets. And that happens.
Many times.
They have done that. Whereas something like DAI.
So have other stablecoins, but something like DAI.
Right, yes. Right. USDC, they've frozen addresses as well. Something like DAI, for better or worse, and I think in my view, for both better and also for worse, like most technology, you can't do that. And so there is a question, I think, whether regulators will, in the end, treat centralized stablecoins that are not crypto native as being somehow more acceptable than crypto native solutions like DAI or Compound Cash, which is the new project that Compound launched.
Yeah, I mean, these are weighty questions for the industry going forward. I mean, and my sense of it is that stablecoins get more traction, and crypto in general captures more and more of the investing public's imagination, that regulators are going to focus on this, and not just in the United States, but EU, other places. I mean, it does bring up questions in my mind as to how would a CBDC work at the end of the day, keeping in mind these types of concerns that we're at least voicing right now. I mean, how would a CBDC work? What technology would they employ? What blockchain would they use? Would it be even a blockchain? I mean, or would it be just some kind of like regional? Like would it be like something like Liquid, where it's like a pegged, some type of federated peg, that's happening with the 12 regional, Federal Reserve banks? I don't know, but there's clearly, as we've seen with the price of gas on Ethereum. I mean, Ethereum's not ready to handle those types of loads, nor would an Ethereum clone, or fork necessarily. I don't know what technology is, and how do I get a wallet? I mean, is it a wallet that's associated with a tax ID? How do they blind that? I don't know. I have a lot of open questions as to how this would even happen.
Yeah, I agree. I think it's unknown. I think it's hard to imagine a CBDC being on a public blockchain. The point of a public blockchain, right? The reason that Ethereum is expensive to transact on is that it is permissionless and yet secure, right? That's why we are willing to spend these fees, is so that we can have censorship resistant, self-custodial, secure financial infrastructure. When you have a CBDC, the incentives, the priorities that central banks have don't really match up in that way. And to your earlier point about sort of identifying the participants in these systems, right? Who is holding these stable coins? What a lot of regulators have suggested is stablecoin systems that do not allow for identifying every single participant at every single point are unacceptable. So, the president's working group on financial markets in January put out this statement with some preliminary thoughts about stablecoins. That's more or less what they said. There was a statement from, I think it was the BIS last year, where they said anonymity in global stablecoin arrangements is, not plausible, or they use some language like that. And so I do think that if you're going to create a CBDC in which you want to impose those levels of restrictions, right? You can't just create a wallet by picking any, random private key from a private key generator, or you're not even really creating that. You're just sort of picking the private key that no one else is going to be able to get. If you sort of don't want that, then you're not going to use a public blockchain. And so I do think we're in this point now, especially in the U.S. I don't know, sort of, where Europe is on this, as well as I understand the U.S. But the question is, how will we compete with what China is doing with the DCEP project? Right? They have a very aggressive strategy around a digital yuan, which is 100% centralized. And the question is, does the Fed create its own sort of like proprietary competitor, or do they partner with private industry? Right? They work with someone like Tether, or with USDC, or with these other private solutions within DeFi to say this is a better way to sort of spread the US dollar far and wide than trying to build a proprietary CBDC blockchain or something like that.
So I think that when you look at the popularity of Tether, the huge use case for Tether is in Asian dollar settlements. And why is that? Well, it turns out that if you, and by the way, Tether, I mean, a lot of people don't really realize this, but a huge use case for Tether is not crypto related. I mean, people are using Tether in Asia for trade finance, for optimizing supply chains, for posting collateral for any number of transactions, right? You can post collateral kind of instantaneously. And when from Taiwan to Singapore, those places are really close. But if you want to send dollars, because everybody wants to settle in dollars, even though there's Singapore dollars and Taiwan dollars, but U.S. dollars is what people prefer to settle in. It takes 2 days because you have to bounce. The time zones are so different than the U.S. and you have to bounce off of a U.S. correspondent bank during U.S. banking hours. And God forbid you need to do something over a long holiday weekend. I mean, so Tether is just basically, in those cases, have just increased the sort of the velocity of money to really, frankly, I think support the economic output of that region. In a small way today, but in a growing way every day in the future. So there's a strong use case for being able to do kind of near instantaneous dollar settlements 24/7, 365. And that's going to be the challenge, I think, for any CBDC, or let's say the Fed, for example. They want to do that. Well, it needs to have that capacity, and it needs to be able to settle somehow on a pseudo decentralized basis, i.e., maybe it's the 12 regional, Federal Reserve, maybe it's the correspondent banks become nodes on this federated peg. Maybe they're using some type of consensus mechanism, not unlike, say, like I mentioned, Liquid before, or something like that, where you have a bunch of trusted nodes kind of doing some type of ring signature scheme or something like that. That could be very high throughput and achieve like Visa level transaction throughput. And I don't know, maybe you want a wallet, you need a tax ID, and you can have lots of sub wallets under that tax ID, but I think that's going to be something, I don't know. I'm very interested, and I'm trying to insert myself into that conversation with people in the government. But it's going to take a while to evolve.
Yeah. Is that Sinju? I think we might be running out of time here.
Yes, we're exactly at time right now. Thank you guys so much for this discussion. It was fantastic. Hey everyone, we are here for our next session, which is around crypto as a hedge against global hyperinflation. Would you guys mind introducing yourself?
Yeah, hi. I'm Stephen McClurg. I'll be moderating this panel, and I'll turn over to Martin.
I'm Martin, Chief Client Officer of Signum Bank. Signum Bank is the world's first digital asset bank today based in Switzerland and Singapore, serving primarily institutional clients.
Hey, I'm Mona. I currently co-founder and CEO of Avantgarde Finance. We're one of the lead developers, researchers, and developers for the Enzyme protocol, which was formerly known as the Melon protocol, building one of the first builders in DeFi, building an on-chain asset management infrastructure. And prior to that, I spent most of my career in traditional finance as a trader, market maker, nearly 10 years at Goldman and 4 years in portfolio management.
Yeah, hello everyone. My name is Ilya Volkov. I'm CEO and co-founder of UHodler, a fintech platform focused on crypto-backed lending and other crypto-to-fiat services. And in addition to that, I'm the Crypto Valley Association Western Chapter Chair here in Switzerland.
Great. Well, thank you, everybody. We're going to start off by talking about inflation, and then that will lead to hyperinflation. So the first question is, what is hyperinflation? What examples of it have we seen in the past? And where are we starting to see inflation creep in, despite the fact that we don't have real wage growth, which is usually a one factor that prevents inflation?
So if I may, hyperinflation is a word many economists have thrown around lately. So hyperinflation is a term to describe rapid, excessive, and out of control general price increases in the economy. So typically, if I'm not mistaken, measuring more than 50% per month, right? So why we're speaking about hyperinflation now? I guess just because due to COVID-19, and not only global banks have initiated money printing measures, which is resulting in the rapid increase of monetary base, right? So 6.5 trillion was injected in the US last year, and Biden just announced a new one. It's something like 1.9 trillion additionally, right?
Yeah, I mean, we have. So on the topic of hyperinflation or inflation in general, the Fed has added $3 trillion to its balance sheet in the last year. So a year ago, there was $3.8 trillion. Today, there's $6.8 trillion. What have we seen in the markets that help to drive inflation or hyperinflation globally?
I mean, absolutely. I think what the Fed is doing is for sure also leading to inflation, no longer only in the hyperinflation countries that we all know, like Venezuela and the likes, but it also will also lead probably in the long term to inflation for more developed countries. And as you mentioned, I think there is a certain asset types that probably they are not so much impacted by the inflation, but what you see is that some asset classes, like for example real estate and commodities, they are quite significantly impacted by this inflation already today. And personally, I expect this trend to continue over the next couple of years. And I think here, and that's then the other topic probably later on discussed, here cryptocurrencies, they offer one quite attractive possibility to diversify and hedge against these kind of hyperinflation. And I think that's also what we now see that, US corporate treasury start to realize, but also institutional investors start to realize. But I think on the institutional side, we are still at the very, very beginning.
Yeah. So Mona, I'm curious, we're looking at inflation, potential hyperinflation. what effect does this have on the crypto markets, on the invention of DeFi, on or even CeFi markets?
I think it's really interesting at the moment. I think you just came off a panel on stablecoins, but I think that the world of stablecoins is really fueling a lot of the DeFi growth right now. Borrowing and lending markets, the ability to, I mean, if you just take a very simple example, I live in Switzerland. I've just been notified by my bank that starting in June, interest rates are going to go even more negative than they already are. And I'm getting warned by my banker that, having cash in my bank account is a bad idea. He doesn't know I'm in DeFi, obviously. And I'm thinking, why do I have any cash at all when I can have stable coins earning me 10 to 15% yield per annum, and potentially like a lot of other interesting things happening. And that's not taking much risk. I mean, okay, sure, there's a little bit of smart contract risk, but that's not taking anywhere near as much risk that you could take in DeFi if you sort of ramped up the risk factors, took a little bit of leverage, or did something else. The returns could be much, much better. So I think that we're starting to see, the explosion of DeFi. I think it's gone from 1 billion total value locked to 40 billion as of yesterday in the last 6 or 7 months, and that's not happening for no reason. I mean, people are tired of not being able to preserve the capital that they work hard for. And I think that it's just clear to me that the money moving into crypto is a direct reflection of the quality and the properties that crypto has that fiat currencies and some other asset classes in traditional finance no longer have anymore.
So where do you think institutional investors are going to go? Look, interest rates are extremely low, even though 10-year treasuries have just spiked up. I personally believe that they're going to go negative. I think this is a short consolidation phase, but US rates will come down, potentially go negative. A lot of European rates are already negative. Other rates around the world are negative. Where do you think institutional investors are going to go to get the returns that they need for their pension clients that require 6 to 8%, for their insurance clients that require 5 to 7%? They're not just going to pile into Bitcoin. They're not just going to pile into DeFi, something that they don't know about. But are you starting to see interest? What assets are they really going to start?
I kind of disagree with you there. I mean, I think piling in is a strong word, right? But I think that at this point, if crypto is not part of your portfolio construction, then you're missing out on something big here. It's not like crypto is new anymore. Bitcoin is like 12 years old now. It's a much more mature market than some of the other cryptos. I'll give you that. But as a pension fund, why shouldn't you have some allocation? Are we still arguing whether it's a valid crypto class or not? Because 40 billion, just the DeFi subsector of crypto, is now larger than the entire cat bond market at 35 billion. So, we can't still be having this discussion about, is crypto a valid asset class? It is an asset class. That's a fact by now. The question is the question pension funds have to solve is how much of it, how much of it should they be taking as part of their portfolio construction? That's a question for people smarter than me who are focused on portfolio construction and risk analytics to take care of. I think you're muted, Martin. I don't know if you...
I think what we observe really that, institutional investors, they are forced to decrease their fixed income basket. Right? Now the question is, where do the fixed income basket, where does it go? And as Mona Lisa also mentioned, yes, maybe a small part of the allocation today goes into crypto. I think probably in the next couple of months, we also see that some of this money is going into DeFi, also from institutional players, even though the discussion that we have with institutional players, they are still a bit reluctant. Exactly, they don't understand smart contract risk, or they want to ensure smart contract risk. I think there are many things growing there in the ecosystem which makes them more comfortable and will make them more comfortable over the next couple of months to really also put the institutional money into these DeFi pools. But I think like today, outside of the crypto world, we also see that some of these fixed income basket is being allocated to more traditional asset classes like equities, for example. But for sure, and here I fully agree with Mona Lisa, like we really need to allocate part of the portfolio into crypto, and I think that's also what's now currently being observed by institutional clients.
Ilya, do you have any thoughts on that?
I had some thoughts mostly from retail investors' point of view, I guess. So if you'd like, if we speak about retail investors, I see at least three real use cases how crypto could help us with combating hyperinflation, potential hyperinflation. So, so if you'd like, so the first one is gold, actually. So if this disaster hyperinflation scenario plays out and fiat currency becomes completely worthless, then it's of course up to society to find a new currency, right? And gold could be a good option traditionally. So gold is a stable asset that holds its value very well in comparison to fiat currencies like dollar or euro. So, but one large downside to gold is the physical nature of it. So it's not convenient to carry around large amounts of gold. So and crypto here brings very nice opportunities. So that's why stable coins like Pax Gold, for example, could be very interesting in terms of combating hyperinflation. And actually, today we've got a very good news. SEBA Bank in Switzerland just announced that they are starting the project around building their gold token. So, which is really good because they're regulated banking institution in trusted jurisdiction. So yeah, so first option is gold. And by the way, I think it should be a good option for institutional investors as well. So
that's great. Well, you know, Mona, you brought up a really good point, and I believe that not only are when I say institutions, you know, I'm talking about pensions and sovereign wealth funds and insurance companies, but you also have you know, others, including corporations that are adding Bitcoin to their balance sheet to transact in a digital economy as opposed to you know, traditional economies. Where do you think these larger investors are going to go that are outside of retail? Is it, you know, it looks like it's Bitcoin for now. Is it going to be in some of these other altcoins or protocol tokens or other DeFi type activities?
I think altcoins will always be. I mean, I think it's going to be a wide range of all of those things. Basically, I think we're still evolving. DeFi is still evolving. I wouldn't say it's a mature market yet. A year ago, we didn't have things like derivatives, options, synthetics, or at least we didn't have any volume in them. Now we have, like, you know, now a year ago, we were trying to figure out as an asset management infrastructure how to drive liquidity on DEXs, you know, and now a year later, you know, there are days where DEXs trade more liquidity than centralized exchanges. So I think that the speed at which things are moving is insane right now in decentralized finance. And also the pop I just explained from $1 billion to 40 billion in 6 months just gives you a sense of how money is moving in and how different opportunities are arising. I think that what we will see is a replication of, so I don't think people are reinventing the what. The financial instruments we're seeing, the financial tool, you know, products we're seeing look quite similar to those that you see in traditional finance. You know, you're seeing people building things that look like things you see in traditional finance, like derivatives, like options, like synthetics, like futures, like leverage tokens, like whatever. But the how is where the innovation is really happening. You know, you're building these products in a way where there's no one in the middle. there's, except for the only thing that exists between the financial participants is the smart contract. In most cases, all participants have full custody at all times. So it's a completely non-custodial system. And that gives it a bunch of new properties, secure properties, that you wouldn't have in traditional finance. Like you never have to, even if I invest in a DeFi vault that's yielding 35% per annum, I have full autonomy, full control over my assets at all time with that token. I can redeem it instantaneously for the underlying assets at any moment. If I make a loan to Martin on, if I make a loan on Compound, I don't need to know the borrower. I don't need to have a bank in the middle to assess the credit rating of the borrower, etc. I don't need to have someone making sure that the payments arrive on time. The smart contracts are doing that all for us, and the blockchain is making sure that those payments are made back to the lender on time. So the for me, it's just like as the market matures, you're going to see more and more products that look similar to what you see in traditional finance in terms of products, but the real innovation is how these products are working. Because they're digital, they operate. There's a lot more transparency. There's a lot more self-custody. There's a lot more control. There's a lot less censorship, and there's a lot more interesting, cool things you can do, like risk management, operations, administration, reporting, stuff that you can do, which you would you really frankly struggle with even in traditional finance, even if you're a super large organization. By the way, the Fed recently wrote a great paper on DeFi. It was published recently, and it was nice to see that they were so optimistic about the use cases and the opportunities that DeFi could open.
Speaking of, what are the current DeFi opportunities out there that each of you like? And tell me why it's so interesting. In addition to what we've already talked about, and also as if interest rates go lower or even become negative, how might you mitigate that with DeFi?
So do you remember, guys, about carry trade strategy from the past? If you remember, it's a traditional strategy when using low yielding currency to fund a high yielding investment. You can make some profits. For example, take a look back at 2004, 2008. Interest rates in Japan were down near like 0.5% and not moving. And meanwhile, the Federal Reserve in the USA boosted rates from 1% up to like 5 or 6%. So investors then borrowed yen to fund their dollar-based investments. And then the yen weakened 20% against the dollar, and large profits were made. So while the carry trade is not nearly as popular today in traditional markets, it's in my mind, it's finding a new breath of fresh air in crypto. Like you can borrow cheap fiat and invest it in DeFi or invest it in CeFi with crypto interest accounts. So I think again, the future lie in the past. So this carry trade strategy is a great example in my mind.
I mean, in my view, and here fully in line with Mona, I think, like, for example, just DeFi lending is like, it's really a game changer because you can put your money to work. You no longer need a financial institution. You no longer need to trust anyone except the blockchain, and probably, and this is probably a systematic risk that some institutions are a bit afraid of. You probably also need to trust the underlying stable coin. That's probably today quite a hindering factor why some of the institutional money is also still on the sidelines, because they say, I also have the risk of the stable coin itself. Of course, if this underlying loses value against the US dollar, for example, I cannot redeem it one-to-one. This is a risk I'm currently taking. It's probably quite a tail risk, but a tail risk which is quite significant. But for me, like, just DeFi lending itself is really a significant game changer. And I think what we see, why can the banks not pay attractive interest rates on the deposits, is probably because they cannot make this money work efficiently for their customers and for the people who are long cash, right? And with DeFi, you have now direct, immediate access. It's an open market. You see, is there more demand? API goes up. Is there less demand? API goes down. And this alone is quite a significant game changer. And then, of course, I think in the next step, probably a bit more complex product, is exactly what we see like with the Uniswaps and the like, that we really can have these liquidity pools to exchange, very efficiently exchange values between different parties, always basically guaranteeing best execution by a smart contract, which is for sure also a game changer. But really the DeFi lending itself is an unimaginable opportunity for all of us, like for retail, for institutional. And I think that what we will see is the protocols are evolving, the pools are evolving, and we will probably see that we have a certain protocol which is primarily dedicated to institutional money, probably with some more safeguards than we see now in the retail space. But there will be products coming out which serve the institutional sector because there is money there, and there is also play money there. Probably not 10% of the allocation, but already 0.5% of the allocation of institutional money is like very, very significant money, and this will come into this DeFi space. And I would say they start probably with DeFi lending. This would be my best guess.
Yeah, I would probably agree with that. I mean, it's probably the most safest and plain vanilla product that you could start with. So I can imagine that would be the first place institutions start. But I think, what do I think is the most exciting? Depends what your risk appetite is, to be honest. If you wanted to lend ETH right now to leveraged borrowers, you could be making 45% a year on your ETH. If you wanted to, but obviously you have much higher risk if for some reason, just as an example, if prices fall too fast for the system to work as it should work, you could be in trouble. I would say that there's definitely risks associated, but we're seeing just so many innovative, cool things. I've as a previous market maker, I'm a little bit more hesitant on AMM pools because of the impermanent losses, although you're starting to see much more smarter market making algorithm. Like, I guess, like, maybe I'm traditional, but I always feel if you're providing the capital, if you're providing liquidity, then you're the one taking the risk. So therefore you should have the upside if a trade goes the right way. And in the traditional AMM model, at least the constant product formula model, you tend to see that it's the arbitrageurs getting all the upside and not the LP, the liquidity providers. So we're starting to see that evolve with dynamic market making paper Loy Lu just put out, for example, this week, or some more innovative. Innovative is not fair, actually, because the original concept of an AMM pool was extremely innovative. But you're starting to see kind of smarter formulas evolve, which start to price things more fairly, and I think reward people who provide liquidity with more of the upside, which is more fair. So I think there's just tons of things that are super liquid. Farming and liquidity incentives are really exciting right now. People are starting to use their own tokens as a way to incentivize liquidity providers. Whether those liquidity incentives make sense or not, I guess it doesn't really matter at this stage. They're there and they're worth something, and people are taking the opportunities. And I think there's a lot of exciting stuff, but a lot of it depends on the risk appetite you have. Someone was asking about the Fed paper, so I'll just link to it here.
Well, on that, we're coming at the end of the time. I'd like to give each panelist a time for any final closing thoughts.
I think if you're not in DeFi or you haven't played around with it, it's just such a fascinating space. Like, instead of listening to panels like this, just get a MetaMask wallet set up and try it yourself.
Yeah, so this panel was about hyperinflation. So I personally think that sooner or later we will see inflation and then hyperinflation, and we will need to find some new way to work with our funds, with our investments. And I believe that crypto could be a really good option. And so we see many of different opportunities to use crypto as a tool to fight hyperinflation. So like we can use this tokenized asset like gold. We can use different trading strategies. We can use crypto loans and other solutions like that. And also tokenization of assets could help us in creation of new type of assets, new type of money probably. So like let's take a look into NFTs. It's something new. NFT are driving a new wave of crypto adoption, and I think it could be a new way to deal with hyperinflation. So yeah, I personally believe that crypto is a great tool to deal with inflation, hyperinflation.
I think also like the audience had the question, like, how much did we talk about hyperinflation? I think DeFi itself is, of course, a very interesting yield generating possibility, but it's probably not the one measure against hyperinflation for me. And that's probably also the institution perception today. If you want to protect against hyperinflation, then probably gold or the Bitcoin itself is the one investment good which protects you against hyperinflation or inflation. And I think on this one, we need to be a bit careful when we talk about inflation, because it's always when the official inflation rate is published by the governments and institutions, it's a bit difficult to say what is in this basket. For example, in Switzerland, real estate is not included in this basket, and real estate increased like significantly in prices over the last couple of years. And I give you a simple example. Porsche 911 was about $10,000 in 1968, right? Today it's 150K. So inflation is real, and I think the very simple feature of Bitcoin that it's limited is actually a very nice thing, especially if you don't think in months and years, but if you think in decades, right? So if you have the problem that you say, how do I put away money for the next generation? Then to put 10 Bitcoins is for sure significantly cleverer than putting 500,000K into a safe, because it will not be much worth in 10 years or in 20 years when the next generation wants to spend the money. So for me, the one investment good to protect against inflation today in the digital asset space is Bitcoin. In the traditional space, it's equities and gold.
Martin, I like your very Swiss Porsche 911 example. It's Porsche 911 index. Very good way to explain inflation.
Exactly. Well, hey, I really appreciate everybody being here today. Thank you for everybody watching, and
That's me to go last because I'm just finishing this thing.
Okay.
Cool. So we are live now. Ian, do you want to kick us off?
Yeah, absolutely. Hi, everybody. Welcome to this session. It's titled DeFi 2.0, Decentralization and the Dilemma Around Institutional Adoption. I'm really excited to be joined here by a bunch of awesome people. We've got Stanley, CEO and co-founder of Aave, Rebecca, General Counsel of Aave, who just joined from private practice, and then Jack from Wire, who's been in the space for a super long time. I'm gonna start by just kicking us off with a couple kind of like starter questions. I'm not gonna like heavily moderate this session. It's just gonna be a fluid conversation between us four. I understand, Rebecca might be here to keep Stanny in check, so that'll be an interesting balance between the two. But I think we have some really great perspectives to share, and let's get started. So I'll kick us off. My name's Ian. I co-founded the venture fund here at IDEO. We've been investing in crypto startups for the past 2.5 years, but been building in the space for 6 years. Lots of our portfolio companies are in the DeFi space. More than half of them are at this point. So we've had a really fun time doing that. Previous to IDEO, I was the head of crypto at Citigroup globally for 3 years, starting in 2014. So lots of experience to share from the institution side as a former institution. With that, I'm gonna turn it over to Stanny. Do you want to introduce yourself and maybe as context, obviously you're building a DeFi network, but just tell us about how you got in and then we'll go around the rest of the horn.
Yeah, definitely. Thanks, Ian. It's a bit difficult to speak as our general counsel is there next to the.
It wasn't planned this way. I was, as you said, in private practice when I agreed to do this panel. But go ahead.
Yeah,
I've heard you talk about yourself in the past. You're good.
So now that I have green line from the compliance, I think just a small introduction is that I've been building now I think 4.5 years decentralized technologies and mainly financial protocols. So that's what we're building now, and probably one of the most important things to be solved in on-chain ecosystems. Now once you solve the decentralized finance, you can then empower other cool economies, which are practically coming later in the on-chain ecosystem. Before building DeFi, I used to actually work in the legal industry. So I found smart contracts by actually trying to do some research on how we could use technology and empower more. I will not say empower lawyers that much, but maybe how we can bring more technology into the legal space and automatize things more. And there was where kind of I stumbled upon smart contracts, and I was thinking what on earth is this kind of thing, and understood that it's actually code which is just distributed in a databases, distributed ways, and found that you could build very cool things. And because before actually getting into law, I was building for years financial applications which are more Web 2, so fintech applications. And fintech has always been about once things become more mobile, internet banking became more popular, and it became more apparent that you can actually do transactions online instead of going to a branch. The fintech startups started to see a lot of space there to build better user experience. So that's what I was doing back then. And now what I'm doing is kind of trying to solve the back end of the finance by creating more efficient protocols that are accessible by wider public. So I've been always kind of a builder and developer, and it's quite cool stuff going on. But that's overall
that's I mean, Stanny, it goes without saying that you are a force in the DeFi industry. But I think it's cool. Some people may not know that you actually studied law prior to building Aave, and I think that's part of the unique perspective that you brought, in building it.
Yep.
Jack, I want to turn to you. Tell us about yourself and your kind of experience in crypto, but also in DeFi.
Yeah, for sure. Yeah, so hey guys, I'm Jack from Wire. So I've been actually working basically full-time professionally in crypto since 2013 as the first employee of Wire. So in terms of my vantage point, I think I've seen a lot of different things come and go in the space. DeFi is obviously here to stay in a major way. So I mean, I think how do I say it? So in the early days, there was a lot of different kind of altcoins in 2013, 2014, right? And then obviously you have this kind of Bitcoin halving every 4 years that causes these bull runs and bear markets, right? And then during the bear markets, a lot of different teams try different things and they try to survive in, crypto winter. So, for Wire, we started basically just building a bunch of different things to see if it works, right? So, crypto payment gateways, building, crypto wallets. And then we started using Bitcoin as a rail to do cross-border payments. So, USD to BTC, and then BTC to MXN or BRL or Euro or GBP. And it was kind of this new way of doing cross-border payments that creates the synthetic FX rate, right? And then obviously 2017 happened with the ICO boom and a lot of different teams. I actually think of those as kind of neo institutions, if you will, because suddenly they have $50 million that they have to manage and deploy the capital of, right? But all the different ICO teams, they had the white paper and they had the protocol, but they didn't necessarily have a lot of real world fiat infrastructure. So Wire kind of then became this fiat on and off ramp infrastructure provider to a lot of different teams in the DeFi space. So teams like Outlet.finance or Dharma, or even if you go to your MetaMask on Chrome right now, you click buy, it'll show Wire on there, right? So just kind of onboarding new users into crypto. And yeah, I think from our perspective, being a regulated financial institution and looking at DeFi, how do we operate within the space in a compliant manner, definitely has been fairly challenging over this past year and a half or 2 years. But yeah, I think of these cycles as bear run or a bear market, bull run, and just building and then scaling during the bull runs, right? So yeah, it's been exciting.
Awesome, Jack. Yeah, super cool and lots of relevant experience from your angle. I want to turn to Rebecca. So you signed up for this panel before you had your Aave hat on. Now you have an Aave hat on. But yeah, want to hear about your background and tell us about that because it's very interesting.
Yeah, so I'm general counsel at Aave, which, as Tony said, is a open source software development company that built the Aave protocol, which is a liquidity protocol. I joined on Monday. So prior to joining Aave, I was in private practice. I started my career at a firm in New York called Crowdcast, where I was just doing sort of straight litigation and regulatory enforcement work. And about 4.5 years ago, I left because I really wanted to focus on crypto. I did one of the very first early private arbitrations between some of the overseas ETH whales and a US-based exchange. And I did it in 2017. And my crypto career just continued on from there. I did a lot of disputes and sort of litigation and stuff like that privately. And then I got into regulatory enforcement work and then into regulatory counseling. And about 2 years ago, I started really focusing on DeFi and regulatory compliance for DeFi protocols and software companies building DeFi protocols. And that's how I ended up here. So I'm excited. And, apropos of what this panel is about, I think looking at the legal and regulatory side of things is really what is going to help facilitate institutional adoption and make larger institutions feel comfortable getting in. And I think there are a lot of great ideas going on in the space, which I'm sure Stoney and you guys will all talk about in terms of how to both have DeFi going on in the retail sense of things as it's been growing, and then also build out a side of things on a compliance with compliance that makes institutions feel comfortable too.
Awesome. Well, it's awesome to have you and the rest of the panelists here. I actually just want to say that I think maybe Stanley's strategy is to just recruit panelists to these conferences. I think that's actually a really good talent acquisition strategy. So I'm gonna have to use that in the future. Okay, so maybe just to get things started, I mean this panel is about institutional adoption. So let's talk about that. Do we think that institutions are going to adopt this? I'm curious what people think, and as part of that, where in the cycle of institutional adoption we think we are. Maybe Stanley, do you want to kick us off on that one?
Yeah. I think there's a lot of institutional interest, especially at least what we're seeing from Aave at the moment. There's of course different kinds of considerations that the institutions need to put in before they kind of can take some exposure in decentralized finance and what kind of product type is interesting for them. because like what's interesting in DeFi is that there's different kinds of offerings. There's different kind of protocols. There's ways to provide liquidity, which is more practice for market makers. There's way to earn on USD tied non-volatile currencies, and there's way also to earn in other ways. So it's kind of like an interesting ecosystem that is growing at the moment. And what I can tell from Aava's perspective is that maybe from institutions, what's interesting is the deposit side. So how you could actually get USD that is in your balance sheet yielding something similar that is yielding in DeFi. So now in current low interest rate environment, I think we have non-fixed deposit rates roughly close to 0%, and in some jurisdictions even negative. And then we have this 5 to 10% yield. For example, the Aave protocol you have on USDC past 30 days rates in a variable rate is on average 10%. So there's like a big arbitrage at the moment, and there's a liquidity crisis. Not a crisis, that's a wrong word, but there's kind of like liquidity crunch at the moment in DeFi. And for a couple of reasons is that the DeFi space is growing in the sense that there's new innovation and new protocols and products coming in. And also those protocols are distributing their governance tokens, and it always involves, the product itself might involve stable coins as deposits, but also it might involve stable coins as a way to deposit and receive governance distribution and governance power. And this is kind of like what has driven the rates quite substantially high. And because the market itself is quite, it's kind of, DeFi is kind of like an ocean. So you can plug in liquidity and also consume liquidity in a this like a very seamless, efficient manner globally. And it might mean that it's way easier to plug into the system, and there would be more growth in the future. And this arbitrage between traditional finance and DeFi might still be very steep for a long period of time, because as new liquidity comes in, as institutions are more comfortable, the liquidity gets consumed because new products are being built, new protocols are being created, and governance power is distributed, and also a lot of new consumption. And I think like in our case, and of course there's like institutions, I mean, it's a wide range. There's institutions could be just a fund holding cryptographic assets such as Bitcoin, Ethereum, and governance tokens, and having those tokens in their balance sheet might be now an opportunity that they can actually plug into it through a custodian and deposit into the Aave protocol, borrow liquidity against, and have working capital finance that way. But what we're trying to now solve for institutions is how they could actually participate in DeFi. There's a lot of things. There's technicalities there. So how and should they custody their own funds? That's the thing. And also, where they get, if they decide to custody themselves, where they get stable coins, for example. And I think Wire is a good example where you kind of are trying to bridge this bridge between what's happening in DeFi and the fiat ecosystem.
But before we move on, because I do want to ask everyone else what their perspective is, but Stanley, can you give us a sense and the audience a sense, like what is the magnitude of institutional interest in this from your point of view, and the timing of that? Like, is it small? Is it really big? Is it like really soon, like right now, or do you think it's like years away?
I would say like the timing is very difficult to say. The amount there is in kind of like an interest. It's much bigger size that DeFi currently is in TVL. But the thing is that you cannot onboard the whole amount and beyond that in a one shot. And the timeline is that it takes a lot of time. For example, some of these institutions to be comfortable with decentralized finance, depending on their own compliance requirements, risk requirements. For example, in Aave protocol, when you deposit into Aave USDC, you're not taking just the USDC risk of the underlying custody of USDC, but you're also taking the default risk of the collaterals that are backing that USDC, and that's where the interest is coming the reward for that. And there's like, for example, if you are institution, you need to review each and every asset that there is based on our risk, framework or their own. So there's like this kind of like a interesting risk questions as well. And I think it's just like some of the institutions participate already, but for like more traditional ones, I think it just takes a bit more time. And maybe time-wise could be something from a few months to a year or two, I would say.
Okay, that's super interesting. At least we're not talking in 5 to 10 years. I'd be curious, Jack, like you were actually telling me right before we joined this that you're quite pessimistic about institutional adoption of DeFi. So tell us kind of like what your views on this are.
Yeah, I wouldn't say I'm pessimistic. I just see certain dilemmas that are catch-22s. I'm not sure how they can be resolved, right? Obviously, if you're a fund that's offshore, that's not in US, then it might be a little bit easier. Every fund has a mandate, right? So, when A16Z creates A16Z crypto fund, their mandate is to invest in crypto, and how they do that from a compliance standpoint might work, right? But when we talk about institutional adoption, I think the definition of what we mean is, the big money, right? So Wall Street, right? Well, Wall Street, they already have this infrastructure set up, with broker dealers and transfer agents, swap exchange facilities and, clearance settlements corporations, DTCC, right? The entirety of how traditional finance works is like oil and water to how DeFi works, right? When you do settlements in DeFi, that's the blockchain. That's Aave, and you're putting in a smart contract call. And so in terms of adoption of traditional finance, the billionaires and all the different funds that wants to, not go through, broker dealer for, booking trades or, going through DTCC for settlement. And now you have to do it through this new infrastructure, right? That seems to be, I don't see where the bridge is in that. And another perspective is if you think about a financial institution from their perspective, right? They have fiduciary responsibility to all of their investors, right? And all the different money that they're managing, right? And so when they assess risk, right, they're looking at counterparty risk, right? They're looking at recourse, right? So, in the case of traditional finance, obviously there's recourse, there's regulatory recourse, and there's every financial institution is regulated, right? So in terms of DeFi, where's the recourse, right? Is it Nexus Mutual? I mean, if it is, then you now have to do a counterparty risk analysis on Nexus and see, are they trustworthy? And obviously, we already know that they've been kind of compromised before as well, right? So it's not so simple to do the risk analysis. With something like Bitcoin, it's a bit easier because Bitcoin is kind of like a pet rock, right? It's solving for a very simple thing, right? It's very simple. And so over time, Bitcoin became categorized as either like money, so money transmitter. So, initially when Ross Ulbricht and Silk Road happened, and FinCEN came out and said, well, the Silk Road situation really puts Bitcoin in the category as money, then that's when Coinbase and BitPay went to become MSBs, right? So there was a clear path. There's a clear regulatory path on what to do with Bitcoin. And so over time, that kind of became institutionalized, right? But with DeFi, is so many different things, like Stanley said, is an ocean, and it's solved for so many different use cases, right? Going from US dollar to a stablecoin is not hard, right? Wire does that, Circle does that, Coinbase does that, Gemini does that, Binance does that, everyone, Prime Trust, everyone's able to go from USD to USDC very simply, right? But once you go to USDC and now you enter DeFi, right? DeFi by definition is no KYC, right? You don't know who's on the other side of the trade. So if you don't know who's on the other side of the trade, you're literally not able to trade compliantly in DeFi, right? So that's kind of from our perspective, at least as a money transmitter, we saw that as an obstacle, where it's like if we wanted to get yield, from DeFi instead of so Wire has a savings API, right? The savings API mostly uses CeFi. So kind of like, the BlockFi and the Celsius of the world, right? Because, they can file 1099s for the interest payments, right? So if you're yield farming and you're getting interest payments, how do you file for that, right? Or even when you initially enter the pool, how do you know how your money is being used? Somebody in North Korea and Iran could be in the same pool, right? And now you're trading against those other counterparties. So those are some of the obstacles we see from a regulatory recourse standpoint and counterparty risk analysis, and how do you assess the risk?
Rebecca, you want to jump in here?
Yeah, so I think the KYC, not knowing your counterparty issue, can be resolved. And I think there are a lot of different projects in the space talking about how to resolve it. And I think while one of the beauties of DeFi is these permissionless pools that anyone could really come into, I think there are ways to make permissioned pools where you can whitelist wallets and do KYC on them and things like that. And I think there are just a lot of people in the space already working on fixing that issue. And I'm not talking Aave specifically, I'm talking 30,000 foot view, that this is something that I think everybody in the space really wants to see happen, because as Stani said, there is this growing institutional interest. I saw it when I was in private practice, just from people wanting to know more. I think just hearing even Mark Cuban on Bankless talk about how he's into DeFi, like this is something that is taking hold. I think we are far down the road, not 5 or 10 years, but I certainly think a year or two, just from getting all the parts in place with the KYC, with permissioned pools. But people are definitely working on it, and they're trying to work quickly, because I think there's such momentum with DeFi after DeFi summer that people want to take hold in that. So
Rebecca, I'm curious, given your perspective. When we say institutional customers, that's like a very amorphous blob of like a lot of big people. Yeah. If you were to kind of take a guess, and this is a hard question, what would the sequence of specific institutional customers be? Are we talking about like banks like Citibank, which I'm guessing not? Like what do you see as like kind of it's going to be these people first, or institutions first, then these, then these, and then these? Like what is your kind of like intuition telling you?
Yeah, I don't have to say intuition. I can tell you what I think I know, which is family offices are first, followed by, sort of smaller, more cutting edge hedge funds. And then, funds that know they have to have exposure. There are plenty of people in the hedge fund space who are like, can you come in and teach me about, DeFi and crypto and things like that? And then I think sort of the dominoes fall after that a bit. I think we are years away from like JP Morgan or Citi plugging into DeFi, like many years, but also that's a survival issue too, right? Like, do you want to be, it's sort of a double-edged sword survival issue, which is we don't want to plug into DeFi because we don't want to give them legitimacy, because we want to make sure third-party intermediaries are necessary. And I don't think, 5 years from now, all the big banks are going to crumble because of DeFi. But it also is going to be a survival issue long term, I think, because they're going to have to do it to keep up. So I think there's that point too. But the big banks in DeFi, I think probably is 5 to 10 years down the road. But I think once the hedge funds come in a serious way and the family offices are already starting there. And when we say hedge funds, I don't mean crypto specific or DeFi specific funds. I think, larger funds are going to get into it as well. And we've even seen Blackstone getting exposure to Bitcoin and things like that. So it's just a matter of time.
And you put corporations like, we've seen companies like Square and, MicroStrategy and these firms like buying up Bitcoin as treasury assets. Do you see them kind of interacting with DeFi more in the bank category or before them?
Slightly before, I think. I've seen a lot from behind the scenes, at least in the New York side of things, how much the bank lobby does not want crypto to take hold. Like they really don't. I think my understanding is they were very instrumental in getting the BIT license enacted in New York. And I just think as a survival mechanism, they don't want to see it happen. There are obviously people there, but it's just a slower machine.
Yeah. Well, for what it's worth, That's why I left. 4 years ago, because I think that DeFi and crypto is the Kodak and Blockbuster moment of financial services, and it's just a matter of time. This is inevitable, and so the question just is like a question of when, not if. DeFi is going to totally disrupt the traditional financial system. We only have 4 minutes left. I could go on with all of you for hours. I have no idea what we should end with here. There's so many good questions here in the chat. Maybe just give people like a final word that they want to say before, unfortunately, we sign off and let the other panel kind of jump in. So maybe Stanny, any anything you want to say?
Yeah, I mean, also like related to the previous discussion a bit, I think what's interesting is that many of the centralized crypto services are using DeFi today. So if you look at Celsius, BlockFi, they both use DeFi, and in the future, I'm pretty sure many of the exchanges will kind of plug into the game. But it's I think what Rebecca said and Jack also mentioned is that there is this a longer period of time of getting everyone on board. My personal vision as a kind of as an innovator and as a builder is to see that at some point kind of this open source way to create protocols and create more efficient ways to settle transactions could be something that the institutions will partake as well. So in terms of building, so let's say Linux currently in each release they have 2,500 developers, and most of them are not actually volunteers, but they are people who work in big tech and smaller companies, and they're paid to contribute. And my kind of dream is that at some point maybe the banks will be contributing to these protocols as well, and they have governance power, and we have more kind of a fair and democratic world in finance.
Yeah. I mean, on my side, I think of Bitcoin as a proxy for institutional adoption of DeFi. And what I mean by that is because Bitcoin has already become like a beachhead into the institutions, right? And a bunch of people are buying, $1.5 billion here and there. That money is gonna, by proxy, come into crypto, right? So you look at BTC and ETH market, and you look at all these other markets. So as the protocol teams like Aave and Maker and Compound and all the new protocols, as their treasury management swells, right? I actually think there's going to be a new institution. I think of Aave as an institution in that sense, right? And I'm not sure that we need to get traditional institutions involved, right? Because once again, that infrastructure is being disrupted, right? So I'm not pessimistic on adoption. I'm more saying that it's oil and water, and we're just going to bypass and replace that infrastructure with new infrastructure. So
yep, Aave is to Netflix as Citigroup is to Block. No one tweet that, please. But no, I mean, for what it's worth, I actually think the future of fintech and financial services is actually doing what my perception of what Stanny and Rebecca and others at Aave are doing, which is you build a decentralized protocol, you build a build a fintech leveraging, or build fintechs leveraging that decentralized protocol and backend. That's going to win, clearly. Rebecca, final word.
Yeah, my final word is actually, it's sort of like a leftover from my private practice days, but I think for anyone on the institution side who's watching and you really want to get in, there are all sorts of new risks and due diligence and considerations. And if you find a really good lawyer who can help you navigate what those are, I actually think it's easier for you to wade into that world. You're not talking about oracle risk when you're making traditional investments at a fund, but if you talk to a lawyer who understands the tech really well, they can walk you through that. And there are plenty of lawyers setting up crypto funds in the space who understand the risk. And so I would encourage anybody who's thinking, on the institutional side to find a great lawyer. Not me anymore, sorry, but there are really good lawyers in the space who can help you figure it out and really facilitate you getting in.
Now it all makes sense why Stanny hired you. And that's a perfect way to close this panel. Thank you, everyone. Continue to engage with us on social and everything. And thanks again, everyone, and Shinju for organizing this awesome conference.
Hey everyone, we're here for our next session, which is on building on hybrid rails, how to think through requirements for building compliant crypto products for enterprise clients. And Jason will be leading this discussion. And would you guys mind introducing yourselves?
Yeah, let's go ahead and start with Emmy. Yep.
Thanks, Jason. So nice to be here. Hi, everyone. My name is Emmy. I'm wearing my Ledger Vault hat today. I have the pleasure of representing the B2B arm of Ledger, which was built in order to provide with infrastructure for securing your critical digital assets in a compliant and smooth way. And prior to Ledger, I had the pleasure to work for Shapeshift. I'm sure many of you know the company which recently changed business model. Shapeshift became DEX. It's also interesting to see such trends or such changes in the field. I hand it over to you, Mauro.
Yeah, I'm Mauro Casalini. I'm the CEO of Bitcoin Swiss Liechtenstein. It's the European representative of Bitcoin Swiss. Bitcoin Swiss was developed 2013 in Switzerland, and it's definitely in the heart of the crypto valley in Zug. I'm responsible for the European strategy, the benefit of Liechtenstein compared to Switzerland. So only that you know, because we have these two places, is Liechtenstein has access to Europe, to the European Economic Area. Switzerland not. Switzerland is kind of an island in Europe and cannot sell its services to Europe. With Liechtenstein, you can do that, and that's why I'm there. And at the moment, we are building a bank there. I'm working on the banking license. Yes, that's what I do.
Thanks, Mauro. Thanks, Emmy. And I'm Jason Truppi. I'm co-founder of Basket, which is a stable security token that produces a yield. It's backed by a basket of global currency bonds, and we're currently seeking federal approval for our security token operation. My background has been in government and in finance.
A moment, Jason.
Oh. Yep, can you hear me now?
Mm-hmm. Yes, we can hear you now again.
Mauro? Okay. Yeah, there's a little bit of a delay, unfortunately. We're talking a little bit about the divergence of traditional finance and the crypto world today. So I think it's really important to talk a little bit about who have bridged this gap very early on, which were the digital asset custodians. They've been building hardware and software that's been safe and secure to use for several years now. It's becoming a lot more prevalent amongst even the larger institutional banking institutions as well. So, Emmy, tell us a little bit, since you're part of Ledger, tell us a little bit about that and how Ledger has bridged that gap early on.
Sure. So I think custody has become from early on a really important element in the field. And so Ledger became famous in 2014 with building the little nanos, and the folks, the founders, really early on realized that this field can only scale if there is adequate security and people can self-custody. And at the Ledger Vault, which I'm a part of that team, basically we realized early on that, okay, institutions are not having such a high appetite for risk, because here we talk about much higher amount of assets. So there has to be a product which just provides with really secure technology, and also important to highlight that basically custodians, what do they have to do? Yeah, just create a very secure product which comes with a lot of features and beautiful governance, because governance is one of the most important pain point for institutions. And also maybe to highlight that fiat is not really involved here, but I think Mauro, you can tell us so much more about that. So I hand it over to you.
Yeah, yes, on our side, definitely. Also on one side, we also have our own vault solution in the Swiss crypto vault, now fully integrated into Bitcoin Swiss. We also stake crypto assets for our clients. And definitely on that side, it's really a big picture perspective where you have to look at various things from the fiat and the crypto side. But yeah, I think Jason, to you or the next question, or how you would like to go on here.
Yeah, I mean, just from my perspective, looking at custodians and the evolution of them, it really wasn't until just a few years ago that custodians were starting to get, certification from traditional institutions and even certification from cybersecurity, looking at things like SOC security certification and all the different kind of regulatory certifications that they would require. And I think a lot of that is because, being a custodian has a lot less requirements. It's actually much more of a simple process. If you look at kind of traditional finance, you essentially have to have custody of the assets. You have to prove that you have exclusivity of funds. You have to prove that you have the funds that actually exist, that you purchased. And so I think it was an easy transition initially for custodians to do that. And because of that, that was one of the first steps before other traditional institutions could actually get into the space. So I think that leads right into my next question is, what do you think of current government compliance requirements right now, and how have they changed in the last year, and where do we sit right now when it comes to EU, and then I can talk a little bit about the US.
Mm-hmm. Yeah, I think that's a really good point. What changed in the last year, because it changed really a lot. If you look at the Financial Action Task Force, FATF, they put out a new ruling that they treat cryptocurrencies the same as payments. So you always need to technically approve, if you're a financial intermediary, that the person that sends you assets is the person who is your beneficial owner. So, and that's in the crypto space. We know it's not that easy. And Switzerland was there very fast. And also when I listen to a lot of podcasts in the United States, a lot of people speak from the Swiss law, Swiss rule. It's really the FATF travel rule is strictly put through in Switzerland. And for every client that would like to send us cryptos, we need to, by a technical way, by the proof process, we call it, we need to get a signature from him that he approves again in this transaction that he's the owner of these assets. So it's very complicated and definitely not that what we expected from blockchain, but it is what regulation brings in the game.
Yeah.
Amy, what's your perspective on that?
Yeah, I just thought it's important to add that we should not regulate crypto in a way like, we regulate ownership to a property or any type of other assets. This is, and I think the regulators have learned a lot the current years, because, they also learn about the various providers, like the players also help educate the regulator. And this is what we've seen happening in Switzerland. Mauro, you're so right that basically FINMA is so happy to learn and see how best they can regulate the players. I lost my thought for a moment because I wanted to highlight something that, really crypto is a bearer asset, right? So you are really the owner if you self-custody, and only you're the one who has the keys. And I think this is important, that we should not forget that, this is here to empower any type of institution as well who want to self-custody. And we just lost Jason for a moment, so I'm hoping that Jason is there. It is. What I hear in the field, that a lot of investors who come into the space, they say that, okay, I'm very happy to invest in Bitcoin and Ether and other proof of stake coins, or like proof of stake coins in general, or whatever asset they want to invest in, or crypto. And they say, but I want to know where these assets come from. And because I'm going to be accountable of the source of these assets, which of course you can understand that as well. Hey, Jason.
Yeah, actually can you guys hear me? Okay. It's really interesting that you mentioned, Mauro, the travel rule. So one thing that's happened just more recently in the US is the FINRA anti-money laundering travel rule now currently applies to digital assets. So, and for those of you who are not familiar with the travel rule, anything over $3,000 that gets transferred from any bank in the US, the banking institutions have to share information related to that money transfer. So now this applies to any regulated exchanges or hedge funds, et cetera, et cetera. So these type of rules are now extending beyond traditional institutions and now into the crypto world. I think it's a good thing in a way, but also it does create extra friction for these exchanges and to comply with these rules. So it does slow things down. I think it does slow innovation down, unfortunately, but it is kind of part of that process. Another thing that just recently came up, is that the former SEC chairman here in the U.S. Who just resigned was close to essentially allowing Bitcoin ETFs in the next 6 to 9 months. So we're going to see a rapid change in types of products that institutional investors can buy, and even non-accredited investors as well. Something like Basket that we're allowing non-accredited and accredited investors to buy a hybrid product, from traditional assets to crypto. So I think we're in a really great place. I think the recent surge in Bitcoin price has helped that quite a bit. And I think there's a little bit of FOMO from the banks, right, Mauro, that they want to be a part of all this, and they don't want to miss out. So we're going to see some major changes in the next 6 to 12 months, in my opinion.
Yeah, exactly. And it was very interesting to see, because in 2017 they all jumped in, the banks. You spoke with them. Then 2018 came and said, we will speak again in a few years, and now they are back. But the good thing is they learned already about it, and now they are able to react faster. And I like to see what's happening in the market. Definitely a lot of institutional money is coming in, and definitely therefore providers like Ledger are very essential on the enterprise solution, because banks can only start with it if they have secure and good custody solutions. If, as I say, they have stock reports for their custody solution. And that's exactly the point also what, for example, we have in Europe. It's the ISAE report. It's the same like stock report. And we have that. That's amazing. And you can show that to the client, to the bank, and they say, okay, that's fine. So we can store with you. That's fine, because our auditor is happy. We are happy. All are happy. And yeah, it's great what's happening in the space at the moment.
Yeah, the U.S. is quite far behind, compared to Europe in terms of actually getting liquidity through a bank. A lot of times you have to get liquidity through, various different means. So you mentioned on our prep call a little bit about kind of some of the banks that are popping up in the EU that allow for this.
Mm-hmm.
Mauro's company is on the verge to becoming a really cool bank. So I'm excited to see when you guys are going to get a banking license. We have a question relating to this, by the way, but sorry, Mauro, didn't want to.
Yeah, I've seen the question exactly, and I can also answer that in the way. That's definitely Switzerland and Liechtenstein are amazing places to build a hybrid or a crypto bank or blockchain bank. We have seen it with Seba and Signum in Switzerland, and where I originally worked since 2013, Bank Frick. We were in the crypto space. That's where I built up the blockchain strategy there since 2015. So it's an amazing strategy, and it's great for banks to touch that area, because we are still very early. And if you can bring in this really modern, agile technology, Bitcoin and or cryptos in general, and you can tell your clients, look, you can store it with us, with a traditional bank who knows what we're doing, that keeps your assets safe. That's amazing. And therefore, for me, banks are essential in the area, because the big professional guys, they will never store by themselves. They will never touch the thing by themselves. They need a fully regulated bank in between, and they are by law not allowed to do it by themselves. But also, if I'm honest by myself, I have some cryptos stored by myself, but for some special tokens, I do not like to do that, because it's too complicated for me. So I even use Bitcoin Swiss or other providers as custodians, because it's easier and I trust them more than myself for some special assets.
Yeah, that's actually an interesting word. Did you have something to say about that, Emmy? Or?
Well, I'm just thinking that, once you have more and more crypto, then you definitely want to at least have a multi-authorization built in there, or, absolutely, it makes sense to give up on self-custody, or just, distribute those assets on various nanos, for instance, or, whatever way you see fit for your own needs.
Yeah, I think, Mauro, you just said an interesting word too, trust, right? And I've thought a lot about this. In fact, I just had a conference with the Crypto Valley Association, and we talked a lot about trust and how the differences between trust in centralized finance, or CeFi, and decentralized finance, DeFi. Let's talk about that a little bit, because I've actually heard both sides. I've heard some people in DeFi saying that, I don't trust the banks, I don't trust centralized government, I only want to custody my own assets, which I think is totally fine. And as long as you're willing to take on that risk to completely control all of my assets. But I do trust, a banking institution that's going to provide something like insurance to me, and maybe do those complicated, backend systems to hold and store crypto. So let's talk a little bit about that intersection between CeFi and DeFi, and where that trust really lies, and where do you think that's going to lead in the next few years between this kind of battle of CeFi and DeFi?
From my perspective, the good point is, in the end, it's interesting because we have to change how we think, because as we know, blockchain is a trustless system. So we do not need trust anymore to interact with each other. So it's amazing. And therefore, for example, decentralized finance and DEXs and so on, amazing. And I have a huge use case, and we can see at Uniswap that in some liquidity pools, there is more liquidity in it than on central exchanges. And that's amazing. And that shows what decentralized finance can do. When I, as Mauro Castellini, can bring in my liquidity in a decentralized finance world, and if I have it at an exchange, yeah, they will also use it, but I do not make money with it. But if I put it in a DEX, I can definitely earn money out of it. And therefore, for me, it's a mixture. And I'm quite sure that in the future, we will see way more decentralized finance applications that will be used heavily. But in front, you still have the intermediaries, the banks or other financial intermediaries that can help you to have access to that. And that's also something what we are working on, being the regulated access to the decentralized finance world. Amy?
I resonate with most of your points. Maybe just, I'm definitely I'm loving DeFi. I hope, and that's why I'm in crypto, because I'm hoping for a less centralized world, so a more decentralized world. I had to think for a moment. No, jokes aside, however, when the amount of funds increase, then my appetite to risk decreases. So, if I'm using a DeFi product, then I can never reach out to their customer support because it's non-existent, right? So, some of the protocols and some of the inventions are just really new. So I definitely don't belong to the first person who uses the very latest applications with a huge amount of assets, right? But with lower amounts, yeah, absolutely. And then once the trust is there, I'm very happy to experiment with and provide a greater liquidity once I feel comfortable.
Yeah, my feeling is that there is a world where CeFi and DeFi can play nice together. And I'll give you a very basic example. So, if you look at the kind of DeFi automated market making liquidity pools, these kind of trading pairs that exist today, right now you can stake any number of assets and produce a yield, based on that. And you're creating the market. The community is creating the market as opposed to a single institution or other institutional investors creating the market. So I still think that can be centralized in a way, as long as everybody goes through the proper KYC, AML rules, you can still have the community make that market for a liquidity pool like that, but do it in a regulated way. So I actually think that could exist in the future. It still would be, quote unquote, centralized. And by the way, when I say CeFi, it doesn't necessarily mean institutional finance. Like CeFi just means some aspect of the financial transaction is centralized, whether that's your identity, so if it's, if we're talking KYC, AML, that's your identity, right? Or if it's some exchange, that you've created, like a Coinbase or Binance, which is a centralized exchange. So CeFi can still work with DeFi in a way, and I think we can still have regulated products. We can have, some level of trust and security, and reduction in fraud and money laundering type activities, through a process like that. How do you guys feel about that as well?
Yeah, I see it the same, and it's really interesting because there is, for example, also a use case in Switzerland that builds up a decentralized DEX, a decentralized finance exchange, with the Uniswap protocol in the back, but they put on a whitelist on it. So you need to whitelist your wallet, and therefore you're able to trade securities from even companies in Switzerland. The amazing thing is, if we would go to a centralized exchange, it would cost a lot of money to list this company, liquidity market making, and everything would cost a ton of money and would not bring the big benefit. With Uniswap in the back and with this whitelist in it, they are fully compliant and they have liquidity. Definitely not a lot, but still there is liquidity, and they have now a secondary market they can use for their own shares. And I really like that, and it works and it's compliant.
Yeah, I agree. I think that's a really good example.
I'm not familiar which company this is, but yeah, like you're relying on them. So this is not the perfect example of DeFi to me. I mean, I'm just trying to play the antidote.
You do not have to rely on them because it's a Uniswap protocol. They only put in the possibility to trade whitelisted tokens. So they do not even make the whitelist. The whitelist is done by the company who hands out the shares.
Okay. Yeah, I mean, my point would have been that the whitelisting is somewhat.
But definitely, it's centralized. Yes.
And can you say what's the name of this company?
Yeah, I will share it shortly in the chat. I only have to check it again that I really have the right.
Yeah, I mean, this is exactly, this is what we're looking to do with Basket, for example. Yeah, I mean, this is a perfect example of where what I can say is I'm very confident that U.S. traditional banking institutions are never going to get fully into decentralized finance. It's just not going to happen without KYC, AML. Protect the investors. Redmond is trying to protect the investors in these type of transactions. But there are ways where that could still occur. What Mauro just described, I can see banks in the US actually agreeing to that. As long as you're whitelisted, we know who's doing the transactions, we know the amounts of those transactions, and we know the to and from location. So I do, while that's not DeFi by this all intents and purposes, it is as close as I think institutionals will get to a decentralized kind of marketplace like that. Does that make sense?
Yeah, I agree with you that we will never see this in the States, as in the United States. Mauro, did you find this company?
Yes, someone mentioned it. I was looking for it. Yes, it was STX.Swiss. Yeah, exactly.
Okay, nice.
Yeah, it does appear that. Go ahead.
Jason, what were you saying?
So yes, they are still in a setup phase, so it's still not fully up and running. But yes, they have the possibility there, and also there I really like it because they had not to develop the decentralized exchange by themselves. They could use what's already there, and that's what I like. You can use an open source protocol; it's there and it works.
So what do you guys think? For our last 5 minutes here. What do you think we need to do next from, when creating these hybrid products? Like, how do we get more enterprises, that are in kind of the traditional world to enter this DeFi and blockchain world? Like, what do we need to do next?
I think, like, when it comes down to what I see with the Ledger Wallet, it's a lot of education, just laying out that what is what. We are here to help them with. Also, it's really important that everything is traceable in this product, what they can use. So you can easily pull a report if needed. You can prove who did what transaction in which amount. You can set rules and roles for different users of this platform, because basically this is a software as a service. What the folks have developed at Ledger Wallet. And yeah, pretty much just make sure that they understand that this is a new, we are super at the early days, right? So this is a new innovative asset, what is here to stay. It's not going anywhere. And yeah, just make them confident in dealing with this type of assets, and probably that's it from my side.
Mm-hmm. Yeah, from my side, definitely, I mean, I see the same as you. And for me, a very, very essential topic is the regulation. We are speaking always about regulation. And for example, also in Europe, we have now a draft of our European-wide regulation for crypto assets, with markets in crypto assets, MiCA. It's the same as it is for the security world, now for crypto. And if that is there, we have a fully regulated environment, and everyone who would like to do it has a law they can rely on. And that's amazing. And it will really boost it up a lot. Definitely the first step, it will slow it down. Regulation always slows down, but in the long term, it can help to boost it a lot.
Yeah, I agree. I think also just, and most of the DeFi folks probably wouldn't agree with me on this, but looking at a company like Coinbase that's going to IPO here in the US, is driving a lot of adoption in North America. You have companies like Paxos that are now kind of getting into more regulated assets that they're going to be releasing. Backed, which is another regulatory wallet that's backed by Intercontinental Exchange, ICE. I think these kind of safer, easy to use digital wallets are driving the adoption, while it's still not ideal, kind of what we envision for blockchain. It's getting kind of the ordinary people into the space and creating volumes on the different assets that are interesting. But I think that's just the first step. I think after that is where where we're going to go next. I think we need to build more specific regulations around crypto. So instead of trying to adopt traditional financial regulations, introducing new regulations, don't stifle innovation, and you don't try to fit a square peg in a round hole, which is what most regulation is doing now for crypto. So there's definitely a lot of work we need to do from the government side, but also from kind of the individual, corporate side as well.
Couldn't agree more, yes.
Hey everyone, we are here for our next session, which will be around the Open VASP initiative, and I'll let the speakers introduce themselves and take it from here.
Okay, thanks a lot, Seen. Great to join you all. We are coming to you actually from Switzerland today. My name is Ian Simpson from Bitcoin Swiss, and we are going to be talking a little bit today about the Open VASP protocol. We won't get too much into the technical details or the legal details because it is a topic which involves some regulatory and legal aspects. Maybe just briefly, the Open VASP protocol deals with FATF travel rule compliance, and it's an open protocol with a white paper which you can find at openvasp.org. And it's basically a setup which allows any virtual asset service provider to be compliant, to transfer and transact between VASPs without being part of a central database or any kind of proprietary setup. And this has been launched in November 2019 with several companies in Switzerland, also with partners in Asia and also now in North America. So today we're going to be talking about that and a little bit about open source and what this means for crypto and how it might go forward. we have Felix Laufenberg, who's a crypto solutions architect at Bitcoin Swiss, and Philip Meyer, who's the head of blockchain solutions at Avaloq. And for those of you who don't know Avaloq, it's a large banking software provider. Bitcoin Swiss, of course, one of the oldest and largest crypto financial services companies in Europe. Felix, you want to say a few words about yourself?
Yeah, sure. Thanks, Ian. So I'm Felix. I have an IT background. Studied computer science, working now at Bitcoin Swiss in the crypto team, designing basically the solutions that integrate our banking systems with the blockchain systems that we're using.
Mm-hmm. Very good. And you, Philip?
Yeah, so I'm Philip Meyer. I'm, as you said, running the blockchain practice at Avaloq. And I have a background also in computer science, but from quite a while ago. And I've spent 25 years in the banking industry, in particular in the equity derivative space.
Okay, very interesting. So as mentioned, the OpenVASP protocol is completely open source. And without getting too deep into the technical details, maybe Felix, can you tell us what is it about OpenVASP that makes it open and it makes it easy to use for virtual asset service providers?
Yeah, sure. So the reason the OpenVASP protocol is open is quite natural when you look at where it comes from. It's sort of a regulatory requirement that is being brought upon all VASPs that engage in the virtual asset services. And the OpenVASP Association is really a coming together of people involved in this marketplace and trying to find a solution together. So it's not really one provider building a solution for everybody else. It's really us coming together to build something that works for us. And the best way to achieve that is to do it in an open way, so that we have an ecosystem that sort of maintains itself by providing incentives for people to participate and by not relying on any central party. So the way we actually do this is by the initial white paper that David wrote that specifies the protocol. And then, of course, we have a reference implementation on GitHub that's publicly available, where anybody can contribute with GitHub issues. And on top of that, we have discussions on the protocol level where we are looking for improvements that are then being signed off and included into the protocol. So really all the development is open, and that really allows us to have multiple implementations of it and multiple organizations contributing to this. And there's really no central point of failure, as we like to say in the blockchain space as well. Right? So it's really quite a powerful concept for us.
Okay. And just to give some background again, so as part of the compliance for the FATF travel rule, virtual asset service providers who send crypto from one to the other are required to send the beneficiary and the sender information as well. Now, of course, that kind of brings up privacy issues or data issues. How does OpenVASP deal with that?
Is that also me? Okay.
Yeah.
So the reason is the way it is built is open, but of course, not all of the data is open, right? We do, of course, utilize all of the cryptography and security that has been used before to ensure that the data that is sent is not visible to anybody but the two parties that are engaging into this communication. So we're really not trying to reinvent the wheel or trying to make everything open, as in everybody can see everything. It's really more about making the protocol open and the standard open, but still apply, the same old principles to data protection that would be used in any proprietary software as well.
Okay. And if we turn to Philip, I'm going to throw out a few numbers, right? Avaloq, as I understand, has offices in 30 countries, 140 banks, 4.5 trillion in assets, which are controlled by Avaloq software. So the question is, why open source? Why be involved in something like this?
Yeah, well, good question. Well, first of all, we believe in crypto, and we have been interested in making crypto mainstream. So one thing we saw is that the crypto infrastructure is still lacking of, there are some gaps, lacking of main features. And so the first thing we did was integrating crypto assets into our core banking system so that they can be traded or transferred natively. And working on that project, we realized that what you mentioned for travel rules was badly missing in the crypto area. And so when we saw the protocol and the white paper, the draft of the white paper David Riglin was writing, we thought, yeah, that's exactly what we think is needed in that area. And that's why we jumped on in that boat, and we helped to create the association, and we also helped to structure this and bring some means also to the association to make it happen. So we believe that openness will help to reach mass adoption. In different initiatives, in similar initiatives, we see two ways of succeeding in this type of tooling. Either you have a set of big players that are kind of building a consortium together, or you have an open protocol which is attracting more smaller players and which eventually gets a strong momentum in the marketplace and then succeed because of that momentum. So we think that this, because of the maturity of the crypto market, the only possible way is the second one. So creating this kind of open association, which is pretty much in sync also with, and therefore we were very keen on supporting this, and we are founding members of that association, and yes, we don't believe for this type of business that a closed initiative managed by a unique company would succeed. This would create a lot of questions from all the actors wondering about confidentiality, because as you pointed out, Ian, there is a lot of confidentiality around this. So the fact that encryption is, as said by Felix, is at the heart of what we are doing, and and we are using also very Whisper and all those technologies to ensure that this is really confidential and encrypted end to end. I think this is also key principles that are that have been attracting for us, and that's why we are supporting this.
Okay, very interesting. There's a couple questions about Avaloq in the chat. We'll come back to that in just a second. Maybe back to Felix just to give us an overview of the state of development on the protocol. There's several different implementations going on, right? How is it going overall?
So we're seeing very continuous progress in the development. We have, of course, the protocol side. We started off with the initial sort of max out version 0.1. Quickly after you something like that is written, you realize there's small things here and there that need a bit of improvement. So we started the OVIP process, which is part of our open sourcing, where we have sort of modular improvements to the initial white paper. So there we have a set of, I think, around 14 OVIPs, something like that, which improve on the initial protocol. These are all finalized and concluded to make a version 1.0, which would be what we are planning to launch. And on the implementation side, one of the big challenges, but one of the really cool things about OpenVASP is that we're not starting out with making one implementation and launching that as you would typically see, but we actually have multiple development teams individually working on implementing this. And we are not planning to launch with only one of them, but we are planning to launch with at least two implementations of the protocol that can work with each other. So as I said, we currently have the two implementations which are quite far ahead in the development. They are at the moment in integration testing, so they have sort of concluded the development and now working out the little quirks of getting it working together. We have another third implementation which is catching up as well. And then we have always, different teams that, join the calls, and they're sort of interested in joining as well. So there's quite a bit of development activity, both on our open source code, but also, of course, there's software providers that are interested in developing their own closed source solutions that they can offer as a service.
Okay.
But of course, integrating with the open source standard.
And do I understand right? There's one in C# and one in Java, right? 2 implementations.
There's one, the 2 that are now close to being done. This, I think, is C# and Rust, and then there's the Java implementation catching.
Okay, very cool. Philip, you mentioned just earlier when you were speaking that you see a lot of like some barrier to crypto going mainstream because of the compliance. Do you think OpenVASP is kind of the stepping stone to take it even more mainstream, even in the banking world and the financial world?
Yeah, well, indeed. I mean, this is, something which was also crucial for us looking at this protocol is extensibility. So it is not a protocol which has been designed only for the FATF rules and the travel rules, and that's it. It's a protocol which is layered into different layers using different messages, and those messages can be also expanded with new messages being created for other purposes. So I think this is a very, very good starting point for something which is really which has large ambitions and which can help to solve a number of issues we see in the crypto market. So looking at and yeah, maybe one more word also. We see a lot of, or we have seen in the past that the promise of being your own bank and that you don't need a bank anymore, and in fact multiplying the number of tokens or the cryptocurrencies is creating a jungle in which the investors have struggled to navigate, and they need help. Like in traditional assets, they need help for understanding which are the right products they need and where they should invest. And we see that the banks are the traditional banks continuing doing this even in the future, in this future world. And what we see also is that thanks to segregated accounts, the investments of those investors are more protected than they were in the traditional banking, because they are sitting on chain. Even if the wallet is ultimately managed by the bank, the solution we provide, for example, is really and not enforcing but recommending segregated accounts for which and for each customer. So the asset of every customer is completely segregated from the asset of the bank.
Okay, very interesting. Maybe let's take one question from the audience, getting a little bit off to the side, but Avaloq, is it looking to integrate with DeFi, liquidity staking, yield farming, banking, treasury, things like that? Maybe
Sure.
A loaded question, but looking forward to your answer.
Yeah, sure. I mean, what we are looking at is we are coming from the traditional world. This is no surprise. But what we believe is that we can bring a lot of value in integrating those two worlds together. We don't see a world against the other. We see more something which is in transition and ultimately will land in this new world. So we believe that over maybe 10 to 15 years, all assets will get digitalized because the current traditional infrastructure is completely outdated for securities. So DeFi is one of those possible new ways of trading with this continuously automated price discovery. So this is something we are definitely looking at. We have a prototype which is demoing the way to create new products on Ethereum. So let's say a bond or an equity or a derivative with all the payoffs being programmed from inception, and then we have an option of moving a slice of that product on Uniswap, for example. And yeah, we would like to offer this possibility to, again, seamlessly and very easily for banks and their customers to integrate new features and new channels like DeFi.
So, I mean, I actually don't know if somebody like UBS or Credit Suisse is an Avalok customer. Maybe they are, but that means that they could eventually be doing things over Uniswap, UBS and Uniswap.
Maybe not UBS, but yeah, we have large customers, and we will make available this in our platform. It doesn't mean that they necessarily will do it, but they could at least, yeah.
Okay, so that's kind of the power of open innovation, or at least open minds, right? You build it, to use the old phrase from the movie, build it and they will come, right? That's
kind of, yeah, sure. No, but we already have customers, maybe not formally asking for this, but we have been working with customers on tokenization projects, so that they understand exactly what it means, large banking organization, how they could issue products for their customers, and how they could offer a secondary market for those products, because it's really important that for investors to have a secondary market and to avoid the lock-in.
Mm-hmm. Okay, so that means that there's definitely a look towards security tokens. To take one other question from the audience.
Yes, indeed. Again, our view is that the current traditional infrastructure for securities is outdated. I'm old enough to have seen this being built, and so I can really tell you that it's old.
Older than you, yeah.
Yeah. Well, I've seen some of the beginnings of this, and again, this is coming from, some of the messages that are used there are coming from the former telex messages that were in use before.
Okay, that's interesting. If we talk about the infrastructure and maybe the architecture, going back to Felix, what can you tell us just about the architecture or also the extensibility? Because Philip mentioned the extensibility of OpenVASP. How does that work, to give some more technical insights?
Right. So Philip already briefly touched on this, that yes, the initial spark of the OpenVASP association and the OpenVASP protocol was the travel rule. That was sort of imposed on all of us, and we have to follow that. So we need somehow the means to actually do it, to engage it, to implement it. And the answer to that is OpenVASP. But we built OpenVASP anticipating that this will not be the only type of message that needs to be sent between different virtual asset providers, but there will be different applications, right? So Swift is sort of something the traditional fiat world, where they are sending messages, and they have, I'm not an expert on that kind of stuff, but they have various types of protocols running, and they have different message types. And we expect very much to see something similar also for the virtual asset providers. So there will not only be, we need to know the beneficiary, there will be other applications running on top of this. So actually really what the OpenVASP protocol is sort of a domain-specific messaging protocol. And then on top of that, you have the applications running, which really help you solve a specific problem, like the travel rule in the first instance. To achieve this, we have built it in a layered fashion, as was mentioned as well. So we are building all of this on the Vacu messaging protocol, which is sort of the successor of the Whisper, which is stemming from the Ethereum community. I think a lot of people probably heard about that. And on top of that, we have sort of a DNS name lookup service on the Ethereum blockchain as a smart contract, where we really go from the mapping of what is kind of the IBAN in the VASP protocol to the how do I technically address the receiver of a message. We also have a different smart contract, which is sort of an authentication service on the Ethereum blockchain, where you can actually identify a counterparty to really be a VASP and know what VASP it is and get all the information that you need to know about the VASP. And then you can really start engaging with messages, and that's the layer where we get into the cryptography, and it's another layer on top of the WAKU layer, which has additional cryptography and message consistency, perfect forward secrecy, and so on. And then on top of that, you have the applications running. So we're already, behind the scenes talking about the next applications that could be interesting. I'm not sure how much I can give away of that, but maybe Philip has something he wants to mention there. But there's for sure more exciting stuff coming in the future.
Yeah, and one thing also is that all of this is blockchain agnostic. So that's also very important for us, that we are not supporting only Ethereum. Of course, you have to implement this on something, and Ethereum has been our choice. We are using bricks of Ethereum to run this, but in essence, the messages are completely agnostic from the blockchain, and this could run for any blockchain, Bitcoin or Ethereum or whatever. So I think that's important, and also just not to compare this with SWIFT. There is a fundamental difference, which is that we know that for example, that the logic will be in the smart contract. So there's no reason, like in SWIFT, to propagate events that are normally that should be propagated on chain. So what we are concentrating on is agreements between parties, like for a transfer, that this transfer is valid and should take place, and then it's then created on chain. But it's not a message that is going to be interpreted like SWIFT by the different parties and then translated into something. No, the transaction itself is and remains on the blockchain.
Yeah, that's a very good point, and I think it's very fundamental to the understanding of the OpenVASP protocol, is that it is just a messaging layer that is to a large extent decoupled from the execution layer of the transactions. That will, of course, remain on the native blockchains as it is. It's just a means of communicating about those.
Mm-hmm. Very, very cool. Again, for anybody who kind of joined in the middle here, we're talking about OpenVASP. If you want to check out more about it, openvasp.org is the place where you can find out more information, check out the white paper, maybe kind of learn a little bit yourself. And I think one thing that's interesting, because we talk on the technical side, on kind of the banking software side, but this is something that can help like large players like banks, or very small players like individual wallet providers, whatever. At any level, it's not something that requires a huge upfront cost where you have to implement expensive software necessarily in order to do something in the space and be compliant at the same time, right?
Exactly. That was one of the key ideas, that we don't have a central party basically having a monopoly on the communication, and they can technically spin up the prices as they want. So the protocol is open source. We have an open source reference implementation. Of course, if you want to rely on a hosted environment, if you want to rely around services, you're going to have to pay for that to somebody. It's not going to be to us. But there's, of course, going to be people profiting from this, which actually elevates the whole ecosystem, because only if you have incentives, you get people building stuff for it. So you can, of course, do your own implementation. You can use the reference implementation or build on that to get something completely free to participate. But there's, of course, you need to host it and stuff. So there's some cost involved, but it really should be a low-cost solution in the end, or at least you can opt in to make it a low-cost solution.
Okay. Maybe one not final question, or one last question to Philip directly. When we talk about Bitcoin as an open source project, and many people, as you mentioned before, sometimes say, well, there's different problems with Bitcoin, there's energy consumption, there's different things. Do you find still among banking clients and so on skepticism around this virtual currency that is open source and not controlled by anyone worldwide? Or is there more and more acceptance of this kind of open concept?
Well, on one side, I think open source is more accepted than before. I mean, even in banks, most of the servers are running Linux, so they are accepting quite well open source software. The thing which is probably more a burden for people, and they get concerned about this, is governance. So who is in charge? Who is deciding to implement a feature or not? And more importantly, who decides to revert a transaction, like we have seen 2 years back on Ethereum. So I think governance is ultimately making the immutability and therefore the trust on Bitcoin and other DLTs. So in that respect, we think, and this is something also we share with our customers, that open source is a better world than closed systems. So regarding the concerns we see, yes, indeed, we see always the same questions, like Bitcoin is not backed by an asset. The Bitcoin value will eventually drop to zero. It's not scalable. It consumes a lot of energy. All the things you read in the newspapers. And yeah, of course, we hear a lot of this. Surprisingly enough, much less when the price is going up like it does currently. So
obviously,
yeah, and for me, that's a little dishonest, I would say. And we have one customer. They have banned crypto, and they stick to it, even if it's now worth almost 50K or 40K, and they stick to that decision. And that is really respectful. But yeah, others are making much more noise when the price is lower than today. Yeah.
Okay. And Felix, if you get into a discussion with somebody about the open source ethos behind Bitcoin, what do you tell them? How do you explain or talk to them about this?
I mean, open source really is at the core of Bitcoin, right? I mean, it's supposed to be decentral. That also means that the discussion and community around it has to be decentral. And even us, I mean, we are sort of a centralized unit in the services that we provide, but we engage so much with different communities of the different blockchains, and we're profiting ourselves so much from the open source community and trying to give back with GitHub issues wherever possible. But it really is a blessing, because without that we couldn't do business either. It's the community effort that really carries a lot on top.
I think one thing that's interesting for me when I think about, products and things that come up, and people always talk about time to market, but one thing that's cool about open source in general is that it enables time to trust. Because if you have the crowd that's checking your code, your implementations and so on, everything can be checked quickly, easily, and then the trust can be built up much faster. So I think that's also something that's central behind OpenVASP, and look forward to seeing how it develops further. I guess we're more or less out of time, but it's been great to chat, and hopefully everybody learned a little bit today about OpenVASP and what's possible, and look forward to talking more about it in the future.
Thank you guys.
Good afternoon, everybody. We'll start today's session with a sound check.
Sound check. Ryan here. Can you hear us?
And Howard here.
Hello. Sound check. 1, 2, 3. All right, we got a couple yeses.
Do we have a couple of thumbs up?
Yep. Eager
We're in
Krieger.
business?
There we go. Yep.
All right, we got a lot of ground to cover, Ryan. So let's get right into it. Good afternoon, good morning, good evening. Today we are going to be talking about selling to enterprise, professional services, and tips for DeFi projects that are looking to get to that point where they're engaging with professional services because the project is expanding, off the drawing board and starting to require certain skills and inputs and deliverables that, frankly, may not be consistent with the skill set of the team that actually came up with the idea. So we'll talk about defining professional services, and then we'll get into how you operate with one another. So before we begin, here's a disclaimer. Again, this covers for both on Federal Reserve and for CBIZ. The presentation's made as is. And our bios are available online. I'm Howard Krieger, Managing Director in Valuation at CBIZ, which is the 7th largest accounting firm in the U.S. Ryan, do you want to give a little bit of your background and then also talk about how you and I got together since it's relevant for professional services?
Yeah, sure. I'm CTO. I guess I call it founder and head of tech for Federal Reserve. I've been doing startups. I'm based in San Francisco. I've been involved in crypto a very long time. I've run teams doing PKI management, security for IoT devices, which quickly got me into this space at a much deeper level. So now I'm just running the technology and technology strategy side of Federal Reserve.
And you and I go back. You and I met because of professional services, right?
Correct. I was working for Accenture at the time, doing professional services for Bank of America, doing Wachovia Securities, and then we met through that network, and
That's
from
right.
there. Yep.
So let's talk about defining professional services. When we talk about professional services, we're generally speaking about outside, non-technical services that you need to consider engaging when launching a product or a project. They may be tax services, accounting, books and records, custody, HR, payroll, insurance, investment banking advisory. Ryan, is there any other professional services you can think of that one might have to consider engaging outside of their core competency?
Yeah, I mean, for our project for Federal specifically, we have a development partner. I can go through that later in the presentation. Hiring, we had a boutique hiring agency through a good friend I've worked with at a hiring HR level for many years. So there's definitely some other things that added value right away from Federal Reserve. Yeah.
Yeah, and the challenge is they add value, but time is the most valuable commodity. And as we talk about how professional services work, it's also a valuable commodity from their end too. And so a big theme throughout this presentation is going to be about organization, about creating, it's almost rote, it's a little bit boring, but something as simple as creating folders for each of the professional services you foresee yourself engaging goes a long way to being efficient in your interaction. And you're going to find when it comes to professional services, being efficient isn't only the highest ROI for you as a founder or as a project participant, but it's also the highest ROI because the less time the professional service person has to spend getting set up and prepping and solely focusing on execution, the more cost effective it's going to be also. So the first question is when do you pick up the phone? At what point do you need to bring in that professional service? The first thing I'll say is you need a rough roadmap of your own project. So you're a founder, you have this groundbreaking, earth-shattering idea that is going to change the world. And honestly, we hope, sincerely, Ryan and I hope that that's the case for everyone out here, that we're all here changing the world. Well, you need to have a good roadmap of what the next like 6 to 12 months of build looks like, and start thinking about what outside services would be triggered as you move along. The simplest one might be something like, well, I intend to make money starting X. Well, if you make money, then you know the tax man cometh, and you need to be prepared, I don't care what jurisdiction you're working out of, to have your ducks in a row now, so that when you engage the tax professional later, you minimize the surprises and the work. So know your project's roadmap. Second part is know what you're good at. Ryan, I'm going to kick this to you. When you say know what you're good at and what you're not good at, what do you mean with respect to the project relative to professional services?
I mean, you certainly know, it's always good to gauge your own strengths and weaknesses, and to always be inventorying what you're good at, what you can improve on, and what you really don't know. So it's really awareness of that is at both an individual level, org chart level, and a company level. Yes. Writing it down and just getting it somewhere and always having it there keeps it out of your head. If you write it down, it's tangible, it's referenceable, you're not going to play games in your head, and you can kind of go back to it when you're saying, okay, where do we need the most thing? I'm okay at certain things. I'm not good at other things. I'm not good at marketing. I'm not good at social media marketing and being real chatty and sort of being doing presentations and kind of and being more social. I'm an engineer. I like to sit in front of my computer. So knowing that I need folks to help get me to there, guide me in order to improve, so I can do talks like this and engage on Telegram and Discord and stuff like that. So
sure, and you're doing a fine job. So you're great at marketing.
Oh yeah.
So
yeah, thanks.
If anybody, but writing it down is key, right? Writing it down, leveraging your calendar, putting these flags up throughout your thinking through your future state to say, hey, you know what? I'm probably going to have to pick up the phone and talk to a professional service provider about X by Y date. So put those out there to get them out of your head. If you're going to capture anything from the next 20 minutes of our presentation, it's this next piece. Network in concentric circles outward. Your advisors, the people that you bring into the project at its early stage, should really be, it's all about trust and efficiency. So you think about your network, it's close relatives, then maybe distant relatives and close friends, going with the blood is thicker than water mantra, then acquaintances that you've met, and then finally cold. And you can have the same network set up for professional services too. Like, oh, I got, cousin Jane is an accountant. Let me call her and see what she knows about taxes. Or, Uncle Bob might be in human resources and he can help me out with it. And with a placement. And you really want to think about those folks and what they do and organize it, write it down. You have these different professional service categories that you're going to need: marketing, taxes, accounting, human resources. Put the names next to it and make it a point to keep in touch with them and set up time to regularly check in. So why do you work the network in order? One of the things to keep in mind is I've been a professional service provider for 10 plus years, starting with KPMG, being the head of a compliance and regulatory evaluation practice at a regional firm, and now being an MD, which is a partner equivalent at service provider. The key is I'm trying to be responsive. If you bring something up, my job is to not necessarily be the smartest, but I should know who is the smartest in the area you need help in. And I should also be acknowledging your issue. So before you're engaged with the professional service provider, they are going to use reliability in an attempt to gain trust. And at first, there's going to be this marketing aspect. As a professional service provider, I'll take the first couple of calls and talk through the issue, no problem, until we get to a point that we have a defined scope of whatever work's going to be completed. And at that point, you're going to be contracted and engaged and the clock starts running. So contractors reserve a little bit for marketing, But at busier times of the year, and everybody's got seasonality, at busier times of the year, my ability as a professional service provider is going to be challenged by making sure I address the people that are paying first. So if you think about evaluation, this time of year is really critical because it's tax and year-end accounting season. So I am more apt to respond to, say, the client need than, say, the prospect that comes in and says, hey, I need evaluation for X, Y, and Z purposes this summer. All aspects of hiring and professional services act similarly. Human resources, you name it. So let me give an example of what the interaction with a typical service provider would be. I put up here custody services. Ryan, if you want to pivot off of custody services as a professional service and talk about your experience as a founder at Unfederal Reserve and who you engaged, how you engaged them, and the end result. I think you were going to do marketing or human resources.
I think we'll do. I mean, human resources was the most straightforward example. My network in San Francisco for various types of talent is pretty strong in engineering. I identified I'm weak in marketing hiring. I'm weak in sort of public relations, sort of that aspect. And you always need a bigger engineering network for hiring because good engineers are hard to find. So we had a friend I'd worked with and closely doing recruiting in the past. She has a boutique recruiting agency. And so I pinged her, and she was able to find a great marketing. She was finding a great marketing sort of person, and then she has in for other people. Another friend who's in San Francisco referred a marketing person that he's worked with for 10 years. So right then, I just got through almost 3 to 5 hours of vetting, going back and forth, and building a trust where they trusted me. More important, just as important as me trusting them, is like, okay, this is a known entity. The process goes much faster, and I'd say in a startup, application of resources and being strategic about it is probably one of the most important things for startup execution. I've seen it kill a couple of my startups and have been successful because I feel we applied our limited resources in the most strategic, cost-efficient way. My couple failures have been a couple missteps. And then I've seen other people fail because they didn't quite know the person, they didn't quite know the relationship, they weren't vetted. And so the risk of them failing at their job or failing in the professional service you're offering went way up, and they completely failed, and it really derailed what the startup was trying to accomplish. So super important.
And I was going to say, that's a really good point, is that the kind of the inverse of, you get what you pay for with professional services a lot of times. So the challenge is that if you go for the cold, right? If I flip back a couple of slides and we say, look at number 4 here, cold, right? If you go to cold, you can pay the money to like believe me, Ernst & Young, KPMG, the big insurance houses that you might need insurance for your platform. They'll take your money and they'll serve you to the extent that you've paid them. But again, you have all the challenges of the you don't know if you really have a true advocate. But the inverse is, if you go with your close relatives and your network, well, then, are they going to take liberties with providing you the best service possible? And I think you bring up a valid point that you need to establish ground rules with whoever your professional service provider is up front regarding expectations. Like, I don't care if I'm sitting around the table with you at Thanksgiving. When I call you, you need to pick up the phone, right? Like you need to work for me. That's a really great point. And so I think one of the other things to think about is think about parallels. Like you talked about some of the challenges and the fails in the past that, well, in every case, you are paralleling needs that come up in other industries. Like when you should never think for a moment as a founder in a cutting edge industry that there is not a parallel out there that you can leverage to find the professional service you need. So here, where we have custody services up on the slide, I think about my background with professional custody and escrow providers on the consumer and commercial lending side. You know, there are these parties that act as you know, safe houses, if you will, for materials, docs, monies, you name it. And the function they perform being this independent holder of stuff that have rules that they need to follow, those rules are part and parcel the rules that custody services providers in the blockchain space have to follow. So if you need a professional service and you can't, and you're stuck because you're like, where am I going to find a blockchain engineer? Well, don't necessarily look for a blockchain engineer. Look for, you know, a human resources support provider, a recruiter that has quals in finding, you know, blockchain technologists.
Yes. Yep. Yeah, right. And another example is our development partner, Web Develop. Vlad's the CEO. I worked with him before. We worked in San Francisco. We shared the same office. We went to crypto events, and then eventually he had a team in Ukraine. He's managing a team of really smart engineers that I've known worked on projects he's worked on, and everyone at the other end was super happy. They're like, it's very sophisticated data platforms, blockchain. So knowing him, it was pretty easy. He's like, hey, Vlad, do you have availability? And we're like, okay. And so a partnership formed, and I can't say enough about getting professional sort of, we call it development consulting, and he's able to apply resources for website fixes. We need to do website cleanup. We're able to do that. And I know it's going to have high quality. Me and him already know how to communicate. It just really reduced friction of the whole process. And anytime you
makes it more efficient
anywhere in your company is pretty much a signal that you're headed down the right track.
Yeah.
Yep.
Yeah. So who do you call? You know, here's an example, right? You call because you have to. One of the things that's critical with professional service providers is you might work your network and your circle as you start putting those flags out there and writing those notes and being like, do I need a lawyer? Do I need insurance? Do I need development services? Let me have those kind of, you know, critical conversations and see. But there's always that critical point where all of a sudden, okay, now we need help. So you decide to engage a provider. Who do you go with? Pick someone you don't know to keep independent. That's kind of a question, right? Because if you go with Cousin Jane, she's really not going to be independent. So of you and your interests. So are you going to be getting the type of service you need? One of our legal advisors, Melissa, she or rather I was going to say Federal Reserve's legal advisor, she introduced you guys to, or she introduced the Federal Reserve to a bunch of different law firm options. And I remember sitting in on those conversations and hearing certain law firms really challenge concepts in the space, like typical crypto challenges, right?
Yep.
And the feedback Melissa gave was, you know, you might want to go with the person that doesn't agree with you, right? You might want to go instinctively with the person that's going to challenge you. But the reality is that when you need that professional service provider, are they going to be there to support you? So when I think about my role as a professional service provider or any of the colleagues at CBiz, you know, when you're talking to those folks, it's important that you want an advocate. You want someone that you can respect their knowledge and their quals, but when it comes down to brass tacks, you don't want the person filing your taxes to be someone that challenges the efficacy of your numbers, right? Same thing with legal. You don't want to go with a legal provider that's going to challenge you per se. You want someone that's going to be an advocate. Trust is especially important. Now, the good, fast, cheap, Ryan. You know, give us an idea of, because that applies to professional service providers too, right?
Right. Yeah, and when we're doing engineering, trying to make decisions, a simple way to reason about and make decisions and think about things. this has been always good from an engineering QA standpoint is, okay, we have product, we have this sort of roadmap laid out to us, we have objectives. At some point, we need to say there's trade-offs, and how clearly do the most effective thing in the past to communicate these trade-offs to business folks, product folks. So, okay, you've laid out something. Do you want good, fast, or cheap based on your business objectives? Pick two is a good sort of thing. You know, you can try to play the middle ground and do good, fast, cheap, and kind of all of them. You know, most people say all of them.
Right.
And they say, well, can't we just do all of them a little bit? But in the end, you really got to get folks to think: do you want it good, fast, or cheap?
You get two,
and it helps them to at least give you a general direction. We want it fast. We want it cheap. We're a startup, or we're not. We're well funded, so we want it good. You know, we want it good, fast, and cheap. You know, they'll be like,
and when you're doing that planning,
right? If you have money and you add 20 engineers, is that going to get you there faster? You know, it's really, it gives a good way to think about it, and it can apply well to other types of professional services.
Right. In some cases, you can't get it fast. Like if you think about like let's say you're talking with investment banking advisory, and they're structuring a deal. Doesn't matter how much you pay, you're not going to get it. You know, or maybe you could get it if you pay enough. But that is something. And then the other thing too is refer to those documents. So like if you leave this call today as a founder and you're like, okay, Howard and Ryan inspired me, I'm going to look at my roadmap and kind of figure out where I'm going to need professional services. You set up those docs, take those notes. When you talk to Jane or Bob, you know, take that down, list out your potential providers, keep farming for those providers. You know what I mean? Like, don't let your Rolodex stop because someone says, hey, you know what? This project uses X custodian. You don't need to look anymore. No way. You need to, it's just like hiring a general contractor for your house. You need to have a couple of 3 options to make sure that you are picking the one that both suits you emotionally, right? Like fits your interest in the project, fits your budget, fits your sense of urgency, and culturally, you know, meets the need. So, you know, with that, Ryan, I put a slide in here, and you know, you provided some of the professional services that Unfed has some level of engagement with, even if it's fairly early on. Yep. So if you'd like, go ahead and go through those quickly, and then we'll get to questions.
Yeah, sure. From an outsourced CFO, KPMG, you know, because of our relationships at Unfederal, there's a lot of this relationship building has been going on for years. Sometimes it started as we started the original project where we were kind of pitching some of these, you know, we were pitching exchanges, offering services, feeling out the market, trying to find product market fit. So we actually built a lot of these relationships. I think the banking one has been a really important one. It was a relationship that's sort of grown over time, and it's going to be, you know, banks don't move fast, right? It's kind of like, this isn't one that's you're gonna move through a roadmap fast, but you're available. You pitch them, you keep them updated, you see where they're going, you offer help from a technology standpoint in general. You know, give them an ear, and so we're really happy about that. The legal, you know, top of the industry, you know, following the industry, following, you know, T0, who's the legal representation of T0? Like who's having to interact at with the government level, and then reaching out to them. So not being scared and going through the fear of, oh, you know, I'm not big enough, I'm not important enough, but you still reach out and say what you need and see if they lean in or not. And you'll be surprised that folks will lean in to a point, and because they want to tee up down the road potentially as the project gets bigger, as it grows.
Sure.
So.
Hey, and Ryan, I'm going to stop sharing my screen right now, so that because that's the end of the presentation, and I hope. Let's see.
I don't see any questions in the question area, and I don't see any questions in the chat. I see a general comment about your dress attire, and some your dress attire, which is nice. I don't know if you want to answer the question where you get that?
I'll tell you this. I always try to rock the polo. The sweater runs from fall to early springtime, and I just feel more comfortable. I feel like when you're in a collared shirt, it's like the uniform. Like I'm getting it done today.
Yeah.
And when I do wear t-shirts, but it's generally after hours.
And professional services, it helps to play the part, right? Even at home.
That's exactly right. Being a professional service provider is about building trust. We always tout trying to become, you're trying to be a trusted advisor. And body language, nonverbal communication is 80%, right? It's 80% nonverbal. And I think it's important to remember that.
I see a question about a chain link, but I don't want to talk about, I want to relate it directly to this topic. In this space, things are moving fast. Who should you partner with? You can't look at the entire scope of the DeFi market on federal. It's just too big, moving fast. So that's why you have a community. I think a lot of our community members are really great. We ask a question, hey, how about this? How about this? Folks like Chainlink and whatnot. We have a lot of community members recommending folks that they've worked with or they're ambassadors for. They've got us in front of the right people as fast as possible and said, hey, I look at this project. I've been participating. You should talk to these guys. And therefore, a really meaningful first meeting takes place. So I wanted to give a shout out to the community. I don't want to talk specifically about partnerships and all that, but I wanted to relate it to this topic.
Yeah.
So
well, it's like the 4 circles.
Helping us. Yeah. Yeah.
Right. It's your 4 circles, right? And then on DeFi projects, and that is something unique, right? And forgive me when we talked about the slides, we thought about the concentric circles of the network, but the community can be a huge source for who to go to, right? Like, I know that there are members of the community that have reached out to you in the past and been like, hey, I'm using so-and-so for legal. You should talk to them also.
Yep, gotcha. And I see some other questions, and I can definitely relate it to the topic. Exchange vetting. We at Federal, we had been talking to exchanges on the other side. We're like, oh, we were doing product market fit, last year. Like, hey, do you want an IRA? Do you want to put Bitcoin in your IRA for exchanges? We were like, hey, putting together some offerings to tease product market fit with exchanges, what their needs were, what do they do with lending? So we flipped that. And so a lot of the sort of tier 1 exchanges and whatnot, we've already kind of known from the other side. So they moved into our kind of middle part, I guess number 3. It's like we knew them at a professional level and they knew about us. So when we come and do our tier 1 vetting, that's kind of, it really helped kind of flush it out. And then again, we ask community members, we have a list of, oh, this exchange is good, this is not, So all of that feedback comes into sort of how we're going to strategically figure out how to move forward and build meet
That's
our
right.
market needs. So.
Well, that's the key is you're building a team. And I think when it comes to professional services is don't be scared to reach out. At the end of the day, every one of those industries is they're trying to make a buck, but B, they also love what they do. So if they'll give you that free bandwidth for you to do with what you need. So thank you all for attending the session. Ryan, do you have another you want to hit it?
I see a question about the developer. I elaborate that on the how we found our development partner. It's Vlad. He's the CEO of Web Develop. I worked with him personally. I've known projects that he was working on with his guys that are working as part of Unfed. He's our development partner. We've worked together. We've communicated on highly technical things before. We have a great rapport. We went to crypto events. So we have a team of, we have 6 right now across the board. We're probably going to onboard a couple more to tighten up other areas in the marketing department and website and whatnot to tee up sort of the loose ends to create a clean marketing image for the company.
Yeah, well.
All right, guys. We're actually out of time.
Hi, everyone. My name is Sam Lee. I'm the founder and CEO of Con Street Partners. It is my great pleasure to be here joining this event today. Today, I would love to share with you on the topic of business perspective of STO. So I'm from Con Street Partners. Con Street Partners is an award-winning AI-powered global decentralized investment banking group. We are also a financial service and asset management firm for tokenized asset and digitized securities. So basically, we run 5 services from token finance consultancy, digital asset management, public relationship, more related to the investor relationship, and also some technology service as well, including tokenization platform and decentralized finance solution. We also run one of the largest online private placement investor roadshow. And we launched the world first annual tokenized asset and digitized securities award last year. Okay, back to our topics today. Business perspective of STO. STO have been, very popular topics, a lot of hypes as well. But at the end, it is a business application. So it's very important to understand the impact and value to the financial service industry. I know many of you are very experienced in the blockchain and the technology, so I'm not going to get into the technical side. Today is more focused on the business, right? I'm sure you know blockchain. Actually, we can look at it 2 ways, right? First is the decentralized applications, which is the field of IT, right? It's increased productivities of enterprise. But the other side is decentralized finance, right? It's a field of finance, including corporate finance, capital market, security tradings, things like that, right? So today we are more focused on this side of the ecosystem. Some key points of digital assets. It's not Bitcoin, it's not cryptocurrency, it's not ICO, it's about real world assets. When we look at STO, the tokens, you can just look at it as a derivative of a securities in a digitized format, right? So the process of creating this token was called asset tokenizations, right? And the offering of this investment product is called security tokens offering. And then it's also have this exchange. But now the regulation framework is getting more mature. Many countries now actually have a separate license for STO exchange compared to crypto exchange, right? So the regulatory requirements is much higher for STO exchanges. If we look at the market size, this is a report from World Economic Forum. So they forecasted by 2027, the total market size for tokenized securities should be about $24 trillion, right? It's a huge future. And if you look at the chart, we are just right at the start now. It's important to look at the market status as well. Is this just a concept or is actually happening? Well, it is actually happening and already have many good deployment in the financial service industry, right? For example, we looked at some of the largest banks in US, right? Wells Fargo, JP Morgan, they're all rolling out their own version of stable coins. If we look further, there are a lot of financial institutions issuing digitized securities in different formats, right? Some are in tokenized funds, some are tokenized real estate, some are tokenized bond structure, and also some of the larger funds also tokenizing the whole fund. And very interesting also, for example, this company Morningstar, They are one of the leaders of the traditional rating agency for traditional corporate bonds. Right now, last year, they came in the market and rolled out the first version of rating product for tokenized bonds. Right, so we see the traditional financial service industry is transforming and embracing the security tokens. If you look further, there are more examples of like government, largest banks, and financial institutions in different parts of the world also doing different trials. If we look at the, this is an interesting aspect. I'm sure many of you still remember ICO days back in 2017, right? Back in 2017, in US, SEC, the regulator, is very against ICO, right? Even today, they're still going after some companies, suing them, for some issues. But for STO, they're actually leading the game. If we look around the world, US is the most popular country for issuing STO in a fully compliance manner, right? So if US is a leader of the capital market, right? Which I believe they are, like because of the Wall Street and all the capital market ecosystem. I think they must know something about the future of STO, and that's why they're running so fast. And if we look further, although different countries, they are on different pace, but in general, they're all moving forward in a very positive direction in parallel. Right, different countries might have a sandbox program. They might have a new regulations. Some might even have a DLT Act, but all facilitating a new ecosystem for the future growth of STO. We look at some of the recent news, right? SEC now is already officially recognized stablecoin and allow the commercial bank to take it as a deposit. One of the early days, exchange Kraken, now they officially become a bank and get a bank license. U.S. Treasury Secretary recommends the FRAC to issue digital dollars, right? And one of the largest, PE firms, fund house, Blackwater, is launching Bitcoin funds. We see some of the largest traditional financial institutions from Japan, SBI, is investing in the crypto banks. And if we look further, over 15 countries now actually have a framework to facilitate the launch and growth of digital securities. So this space is very hot. What is going on, right? If we look at the STO, the value proposition, the benefit is actually have benefits to both the corporate issuers and also for the investors. I'm sure you can find all this information online, so I'm not going to go into details of each of them. But what I will share with you today is a deeper perspective from an issuer point of view and an investor point of view. First of all, from an issuer point of view, right? So for companies issuing STO, of course, it probably be used as a tool for fundraising, right? This is a traditional fundraising or growth cycle of a corporation. As you see, the yellow line is the growth along the funding path as the company get more mature, right? It's all started from a startup conception, self-finance kind of status. And I'm sure you know, like many startup company, many will fail, only a small amount will success, right? So they go through this valley of death. Those who survive might finish a prototype and will get some angel investor, right? And then later on get VC, Series A, B, and C, and so on. And then they will get accelerated funding. And eventually, like many of them is targeting for an IPO or M&A from a bigger companies, right? This is a long journey. It is not easy to make it to IPO. Many companies fail along the way. So when we put back the token financing in this fundraising path, right? Because no matter what's the method of fundraising, this journey is the same, right, for fundraising for different enterprise. Okay? They just utilize different funding tools. So if we look at ICO back in the days, this is where they are, right? Because if you remember, right, well, many of those ICO projects are startup project with concept, with a white paper, and doesn't really have a product or customer yet. So they're very early stage companies, right? So this is where most of the ICOs are located. For STO, we think the sweet spot is somewhere at the latest stage and before the IPO, right? Because STO is about the securities, right? It could be tokenizing the shares and the corporate value. So it will be more beneficial for the enterprise to start doing that after they already have, for example, a Series A fundraising, maybe you're in a Series B, even for PIPO. And from the investor point of view, so this is asset allocation by different asset class, right? It's not most up to date. I tried to have update information, but just bear with me for now on the concept, right? So the largest portion of the asset allocation as of today is on the bonds and debts, right? Not surprised, right? All these government bonds, corporate debts, so they're the largest. And the second largest is the real estate, right? And then become the equities. When we talk about all these IPO, like stock exchange, trading, they actually just the third largest as the equity. And they also cash and ETF. And as you can see, digital asset, recently we just reached a $1 trillion mark of market valuation. But still, compared to the rest, it's just a tiny bit. So how does asset tokenization comes in, right? First of all, one interesting note is since the invention of ETF back in 1990 from Canada, digital asset or Bitcoin, right, born in this world in 2008, is actually the first new asset class in the past 20 years. So the financial industry pretty traditional. When we talk about asset tokenization, first, we can talk about tokenizing a lot of the existing asset class, right? It's like tokenizing bonds, tokenizing real estate, or tokenizing the shares of the companies, right? The shares of the company will be more interesting because the equity in this chart is more referring to publicly trading stock, right? But now we can tokenize a lot of the private companies and privately trading stock, right? Or the future unicorns, right? The other aspect I think is more interesting as the financial industry is getting more familiar with the asset tokenization and STO and all these tools they can utilize. I'm sure many smart people can think of some new products which we haven't seen today, right? That is the exciting piece. New financial products. For example, now I have already seen some example, right? So traditionally, some of the more risk-averse investor might like to invest in a bond, right, where they collect a fixed interest rate, a coupon, but with less risk and be able to get back the principal in a few years, right? But the return is much smaller in that case, right? It's fixed income. And now I have seen tokenized bonds that actually include an upside for the business performance, right? So in some element, it have the fixed income element as the base, but it also have some of those upside element that people invest in the equities, right? So they do distribute a portion of the dividends or profit of the company to the tokenized bond investors, right? So the bond investor will get the best of both worlds. This is one example, right? Another example is that in the real estate, we see more fractional tokenization happening now. So traditionally, but fractional ownership is not a new thing, right? If you look at the REIT, right, the real estate fund, literally is fractional ownership because people invest in the REIT unit from a stock market, right, publicly traded REIT, and then the REIT itself own a portfolio of real estate, right? But now, because of the cost efficiency of the blockchain, right, and also like, you know, the global settlement capability cross market, right? So issuer now can issue almost like a REIT concept, right? Because it's fractional, but down to a single address, down to a single property, right? So this will be very interesting because the investor, they can actually pick a specific real estate to invest in instead of invest in a portfolio, right? They can even create their own portfolio with a small amount of capital. So I'm sure there will be more and more new products that we can see from the market utilizing this structure. And on a bigger picture, we can literally tokenize anything, right? For example, tokenizing ownership of a fixed asset, of some equities or commodities, or even the fine arts or collectibles items. We can tokenize cash flow, just the revenue, the profit, and the dividend of the companies. And we can tokenize debt, like corporate bonds, debentures, mortgages, magazine loans. And we can also tokenize the whole investment funds, like REIT funds, like mutual funds, collective investment scheme, and so on. Right? So the security token, the token itself, is a form of derivative with an underlying asset. So we can swap to different type of underlying assets. In the process, to make this happen, we can look at it in a two-step approach, right? First is the initial offering, right? During the initial offering, of course, like it's almost like a mini IPO process, right? It is not as complicated, but if you think about it, is similar in a way that we need to have the professional firms, right? Like accounting firms, lawyers, to look at the asset itself, right? To do some due diligence, evaluation, and then create some kind of financial structure, and then make into an investment product, right? And offer to the investors. And along such process, of course, it needs to be fully compliant with law from different jurisdictions. It depends on where the securities or the STO is being issued from, right? There should be a domicile jurisdiction, and such STO should comply with the security laws in such jurisdictions, right? Once we've done that, then we can take care of the technical portion of the tokenization, the smart contract, you know, selecting different type of blockchains, and you know, doing the online investor onboarding, utilizing the KYC tools, subscription, and different type of wallet and digital custodian facilities and solutions. And after the initial offering, right, that's the initial fundraising, then it's to move into the secondary trading. As mentioned earlier, there have been sandbox from different countries, different jurisdictions, and now we have seen many already have companies graduating from the sandbox one by one, right, and getting official FTO exchange license. For example, back here in my home in Hong Kong, we have already got the first license STO exchange. In Singapore, they are 3. In US, I think there are 6, and the 7 is coming out. In UK, I think the first came out. So there will be similar coming out from Japan, Korea, UAE, and different countries as well. So we are seeing now the ecosystem is being complete, right? From the initial offering, initial fundraising to secondary trading. So on the secondary trading, The interesting thing is because this is on the blockchain, unlike traditional securities, it made multiple listing on different exchange much more easy, right? We have seen that in crypto exchange, right? Same token, the same cryptocurrency can list in 20 exchange, right? But now we're talking about securities, right? It's being traded globally 24/7, right? So this is very interesting transformative move to the traditional equity markets. And of course, there also requirement of some of the traditional service is once the security is listed, we still need like investor relationship, a proper reporting mechanism, custodian, and in some cases like liquidity management and accounting, auditing report, things like that, right? And so after all, this is a proper investment product. So apart from all the good things, there are actually still a lot of challenges and risk. We are still at the very early days of the market. For example, the value chain is very fragmented right now, right? If a company trying to do an STO, they probably have to deal with like 5, 6 different solution provider, right? Such as like online KYC, token issuing, custodian solution, and liquidity management and crypto STO exchanges. And very often they all being offered by different companies, right? So it's not easy to work with all of them. And secondly, the regulation is still, on the international level, every country is on different pace. Some are faster, some are slower. I'm sure eventually they will all catch up. But at this moment, the international distribution is still need to address such issue. On the secondary trading side, although many we see as licensed STO exchanges coming online one by one, but it's still at their start, right? So the liquidity is at the early stage now. Education is very important. Education to the issuers, education to the investors, to the regulators, and also traditional financial service provider. Right? I believe a true success of the industry must come after the convergence, right, from the traditional service provider and the new breed of firms to take the whole industry to the next level. And also, as this is a proper investment product, right? All this performance tracking, reporting, valuation, and analysis is very important, right? Like when we look at the stock market now, we can find like very good analyst report on a particular stock, right? Like financial reporting and tracking. So we like to see the same happen in the STO space as well. As to wrap up, so if you worry whether you will be late, because a lot of things already happening, please don't, because we are right at the start. And there's a lot of change, but I think this is normal because it's part of the industry transformation, right? We have seen the same on different transformation, right? Same thing happened in e-commerce. Right? If you remember, when the whole internet thing started, people don't even feel comfortable to put the credit card online, right? Now it's a no-brainer. Like as we see COVID, and even I think after COVID, e-commerce will be very different. Right? This is huge opportunity ahead. We have seen what the internet wave have done to the telecommunication and the media industry, right? Completely transformed telecommunication and media. But internet wave back in the millennium, right? Even as of today, haven't transformed the financial industry as much, right? Compared to telecommunication and media. But we believe this wave of blockchain now is going to take do a big transformation for the financial industry. So I compare now, almost like the 2003 for the internet wave. I know some of you might be maybe still in school back then, but if some of you have experienced such wave, you might have a better recognition of what happened back then. Why I say 2003? Because back in 2003, the industry came out from the crash of the dot-com crash, right? Consolidate, and then the big players coming in, looking at more seriously, and also most importantly, at 2003, the whole industry is right around the corner of the next big wave, which was smartphone at the time. When smartphone came out, it changed the whole industry, right? All this cloud service, video streaming, app store, connected device, it takes the industry to another 20 years bull run until today. I think same thing is happening to us now, right? We obviously came out from the crash from 2017. We survived the crypto winter. Now we see the spring coming around. And the whole industry is ready with the regulations in place, the regulators' positive direction, a major financial institution coming into this space and really launching a large-scale campaign, endorsement and embrace of the Bitcoin from traditional financial institutions. So I think we are now ready for the next wave of STO. So it's very excited and looking forward to working with all of you to take the next ride of the transformation. Thank you very much.
Thanks, Sam. This is great.
Thank you.